and we'll be starting, shortly. Trying to give room for, more participants to join. But in the meantime, please confirm if you can hear me clearly. If you can hear and see my screen. So you can help confirm via chat. Okay. All right. Emmanuel, thank you so much. Okay. So today we have, quite a lot of activities to cover. So we'll be moving quite fast, and there's, a lot to learn from today's session. All right. Okay. So let's just give a grace of 3 more minutes just for the purpose of those. Okay. Just for the purpose of allowing more participants to join, then we'll just start. So let me do a quick run through of what we'll be looking at today, and of course, just do, a little recap of what we did yesterday. Okay, so today, let me start with yesterday. So yesterday we looked at uh, differences between an ERP and an accounting system, right? And we looked at what a general ledger is, what is a chart of accounts, and what are those things that we need to note, you know, when dealing with, chart of accounts. How do we create chart of accounts? We talked about that. We looked at, setting up our own company, which is the Sage Business Cloud, accounting software, and what are those things that we needed to know. What is VAT with respect to, accounting software, and how, system treats that. We looked at that yesterday, and we equally, looked at creation of items, which is master records, right? We created ledgers, we created items, we were able to categorize our respective items, categorize, suppliers, and create, respective supplier records. Same way, we looked at, the customer's master file, and we looked at categorizing customers, and a couple of categories that we probably would have in a typical business scenario, and how it works with the software. So today we'll be looking at treating what we call opening balances. We'll be looking at treating customer related transactions, suppliers related transactions, look at the respective search documents and how we can, process them, within the system. And those things that we need to note, when processing such documents, with, an accounting or ERP system, there are a couple of things that you need to look out for. And there are a couple of ways that even when you make mistakes on accounting systems, there are ways that you reverse them. There are a couple of things you need to note. So we'll be running us through all of those. So today, we have so much for us, and it promises to be, very, very exciting. Okay, so that being said, my name is Aziz Adeomi once again, and I have, in this session, my colleague Timileyin Okonlawon, who is equally a co-facilitator for this session, right? And let's just get right into it. Welcome once again. Okay, so we'll start by logging into the application, right? State Business Cloud Accounting software, right? And we looked at uh, yesterday. We looked at how we can access it, and we said for you to be able to log in into the software, you need to launch your browser, and from your web address, you need to type in accounting.sage1.co.za, right? Then you click on enter. So same thing is applicable even with your phone, right? So here you enter your username and password, uh, right, which is, you know, very very significant to you, right? So now we are logging in this page, then you click on login, right? Okay, so now we've logged in into the system. Let's see, no audio. Okay, sorry about that. Is it better now? Okay. Please, I need you to confirm if you can hear me clearly before I proceed further. I want to be sure we don't, miss anything. So please, I need you to confirm if you can hear me clearly. Okay. All right. Thank you, Luadari. Okay, it's not loud enough. Okay. Okay. Thank you, Christopher. Okay. So, for Formula, you might need to check your volume. So I've just increased the volume of your device. So I think, let's see. Yeah, I think I'm good to go. All right. So now let's just get right into it, right? So we'll be making reference to, our class exercise, and one of the things we'll be looking at, note this, that before you start the use of analysis, right? Now, once you have all your master files set up already, your items list, be it service or be it physical, right? You have all your customers list, suppliers list, created into the system, and you've set up your company's information, right? So the next thing you want to look at is this: you want to look at imputing opening balances, right? So what are opening balances? When we are out there and we hear, oh, we want to create opening balance, or we want to bring in opening balances into our system, or we are being asked to generate, a report on opening balances. What does it entail? What does it mean? At what instance, do we get to use that term, opening balances? So the answer is as straightforward as this. You know, whenever you are making use of a system, let's say we are just starting, the use of this software for financial year 2022. Remember, from yesterday, our financial year runs from January to December, right? In our typical scenario here, right? So now we've been in business. Let's say we've been in business for year since year 2010, right? But then we are just starting the use of a new accounting system, you for January 2022, right? The way it works is this: we won't just say, oh, because we've created our suppliers, our customers, and all our records, we want to just start, posting. It doesn't work like that, right? There are some balances that, that the business already has, that we need to bring in into the software. What are those balances? Take, for instance, your bank account. As a business, it is expected that you would have bank account, and individual bank accounts would have their balances. So you won't say that because you are just starting to make use of, Sage, uh, you don't want to, you want to assume that your bank balance is just zero. No, you would have, let's say, as at December 2021, which is the last day of, last financial year, right? You have some items, in stock. Remember, for the purpose of our training, right? We are our firm, which is the training firm we are using for this practice now, deals with shrimps, prawns, talk about seafoods, right? It's a seafood company. So let's assume that as at December, as at 31st December 2021, which is the last day of last financial year, we have some items already that we are yet to sell. You know, we are here to sell them. So they are in stock, right? Now, because we are making use of Sage as at January 2022, we need to consider those quantity we have on hand, right? So those are what, so we'll be treating them as opening balances, right? Same thing is equally applicable as at December last year. Let's say there are a couple of customers that are owing us. We won't say because we are making use of a new system, we would forego, those balances that they are owing. No, we have to recognize them into the system. We have to consider them, and that is why we call them opening balances, right? But then let me also state further, right, that you would have instances where you'll be hearing the term opening balances, and you would equally be hearing the term closing balances, right? Don't get it confused. Don't be confused at all, right? Opening balances or closing balances, they could be tagged, to mean the same. But then it's just that the scenarios at which we use them differ. What do I mean by that? Now, let's say as at last day of last financial year, which is 31st December 2021, right? Just like I said, we have some quantities on hand, that we are yet to sell. We have some of our customers that are owing us, right? We have maybe one or two vendors that have supplied that we've not paid fully, right? Those are equally, liabilities on our part. We have some balances in our bank account and cash, right, as at 31st December 2021. Now, if it is the last day, right, if it is as at the last day of a period of a financial year, you will call such balances or such quantities of inventory that you have, you will call them closing balance, right? So it simply means whatsoever it is that we've counted in terms of item, or whatsoever it is that we are owing or our customer are owing us, if it is as at 31st of December 2021, right, it simply means they are our closing balances for 2021. Those are our closing balances, in our books before we close, our books for the year, right? They will be called closing balance. But remember, the moment you transition into January 1st, 2022, right? Those set of balances that where your closing balance, right, would automatically be called your opening balances for 2022. Remember, as at December 31st, 2021, let's say we have a balance of 500,000 in one of our bank accounts, let's say GT Bank, right? It's a closing balance, right? But the moment, you are considering 1st of January 2022, such a balance will be called your opening balances for 2022. Note, your closing balance for a particular financial year, right, or a particular period would automatically become your opening for the next, financial year or financial period. So remember that same 500,000 that we're having as our closing balance in GT Bank as our 31st of December 2021, right? Is still the same thing we'll be calling our opening balance, right? As at 1st of January 2022. We won't write them off to zero because remember, we stated at the point, in yesterday's lecture that any balance sheet item, such as our cash or our banks, right, or any balances at all, they would always roll over, right? So that is why, those set of balances that are closing in last financial year would be our opening in this financial year. So when you hear someone talk about closing balance, when you hear someone talk about opening balance, don't get it twisted. One is just used at the end, of a particular period, which could be at the end of a month, or at the end of a financial year, or at the end of a particular day, right? But they would automatically become your opening balance, when you are considering the next period. So I hope we get this clearly, and that is what we'll be treating, right? That is what we'll be treating. So please, I hope we all can still hear me clearly. I hope we are together. So please confirm, and I hope we got that explanation of what a closing balance is and what an opening balance is, and we would be able to differentiate at this stage the difference between the two. So please confirm if you can still hear me clearly, if I can proceed, because we are about just practicalizing what I had just explained. So please confirm if you can hear me. You can confirm via chat, just to be sure we're on the same page. All right, thank you so much, Dari. Thank you, Emmanuel. Thank you, David. All right, thank you so much for that. So now let's now put into practice. How do we enter opening balances, into an accounting system? Now, the scenario we'll be looking at would not just be peculiar to say business plan accounting, right? We'll tell you those things that you need, right, which is part of the information we shared with us on our class exercise document. So we'll be making reference to our class exercise document too. We have an exercise there that is talking about opening balances, right? Okay. Uh, okay. So we have an exercise there that is talking about opening balances, and here we are, right? This is saying these are the opening balances, right, and transaction for financial year 2022. Right now, you will see from here that these are the opening balances of customers. Right now, when you are talking about opening balances, right, you need four things. Whenever it is that you are treating either opening balances or closing balances, as the term could be, you need four things. Right, and what are the four things that you'll be needing? Okay, you'll be needing what we call the tri balance, which is the most important in this case. Remember, your tri balance, is a summary of each ledger balances that you would have, right? So for those that have accounting background, they understand what I mean by trial balance. Now, for those of us that are non-accountants, trial balance is simply saying, as at a particular period in time, those bank balances that you have, those inventory, that you have, those liabilities, those computer, those assets that you have in terms of the value of your motor vehicle, the value of your, those balances that you have as at a particular time, all the balances you have in your ledger account, right, would be resident in your trial balance, right? So you need your trial balance, which is the summary balances of all your ledgers, right, as at a particular period, right? I haven't said that. That is the primary thing you will be needing. But then, aside from trial balance, we have some supporting, we call them schedules or breakdowns that you also need to have, right? And they are this, right? You need a schedule for your customers, for your suppliers, and for your inventory item. Why is this important, right? You see, when we are talking about an accounting system, we have a term, that we do call control account. There are some ledgers that directly, they are called control accounts. And why is that? It's simply they are being called control accounts simply because they have some older series of records that report into that ledger. Now, a typical example is you talk about your account receivable ledger. In some systems, they call it trade receivable. It's a ledger, or in some systems, they call it customers ledger, or they call it customers control account. Right now, it's a ledger account, right? But then it's your customers transaction. You have a ledger called customers control account. But then you now have series of customers. Aziz could be your customer. Droidedge Consulting could be your customer. Polaris Bank could be your customer. These are different customers, right? But then when you are recognizing transactions in their name, they need to report to a ledger account. And that ledger account, all your customers will be reporting to, is being called, your customer control account. Or in some cases, they call it, account receivable ledger, right? That account receivable ledger is your control account, right? Same thing works for account payable. Account payable is responsible for transactions with respect to your suppliers, right? And your suppliers could be sundry or they could be trade payables, like we explained yesterday, right? Another control account that you would always have in accounting system is your inventory control account. Now, you have series of items that you sell, right? At any point in time, when you sell and when you stock, right, these inventory items, transactions, that are relating to them will be reporting to a ledger, called inventory control account. So all of these ledgers, these three ledgers that I mentioned are called, automatically they are called your control account. Now, when you want to bring in opening balances, you will see in your ledger and your customers, control account, you can see that, oh, all my customers are owing me a total sum of 2 million naira. But that 2 million naira is not enough. You need a breakdown of, which customers, who and who, balances, made up that 2 million. For instance, if as this, Nigeria Limited is owing you 1 million, say Droidedge Consulting is owing you another 500,000. Let's say Polaris Bank is owing you another 500,000. Those are the breakdowns we are talking about. That makes up what we call a schedule. Your customers balance schedule. It's a supporting, document, right? It's a supporting information you'll be needing when you are treating opening balances. Remember, we talked about trial balance, which is primary, but then in a trial balance, there are a couple of, control accounts that you need to provide breakdowns for, right? And which are, I will take it again. Your customers control account, which also is your customers balances, individual balances, your suppliers individuals balances, and your inventory, individual balances. Individual inventory, their quantity and their cost will give you the value, right? So these are the four things you need: your trial balance, your customer schedule, your supplier schedule, and your inventory schedule. Those are the four things you'll be needing. And same thing, we have the four, set of items listed in the class exercise here too. So for customer schedule, we have this, right? Right. We equally have for supplier schedule, we have for item schedule, and we have here our trial balance, our trial balance, which is here, right? Now you see that our trial balance is in debit and credit, right? And it contains individual ledger balances, plant and equipment across. These are individual ledgers, right? Both debit and credit. But you will note one thing: look at our account receivable here, right? Look at our account receivable, okay? Account receivable, which is here. One moment. So look at our account receivable here. The balance here is saying 1,050,000, right? But this 1,050,000, there needs to be a schedule, just like I explained. Now, let's now look at our schedule. Remember, the figure is 1,050,000. These are individuals, customers' balances. They equally made up that 1,050,000, right? They made up that one. So they must balance. Your schedule must balance with your total balance that you're having in your trial balance. That is how opening balances works, right? And remember, we talked about the reason why we'll be needing to do opening balances. So we need to bring, our balances, before they start, off using an accounting system. But note, once an opening balance has been treated, the system would always, calculate opening balances and closing balances automatically by itself. The only period you need to do opening balances is when, if you are just using that system for the first time. That is when you need to migrate opening balances into the system, right? Then secondly, let's say there's a customer that you've not been posting their transaction on a particular system. Now you want to create that customer, but then the customer is having a balance before you create, into the software. Then you need to bring in the opening balance for that customer, or for the supplier, or for inventory, and the likes, right? Those are just the scenarios. Now to treat opening balances, you know, within say business cloud accounting, you need to go to the company's module, the company module. Under the company module, you have a specific screen called opening balances, right? I will click on opening balances, right? And this is what it looks like. You can see opening balances, and you see the system is saying your opening balances from your previous accounting system, right? And you need to select the period, the date, at which you are bringing in that opening balances, right? So I need to change these dates, to, it could be of two ways. We could treat this set of balances as closing balance. Meaning we'll be using 31st of December 2021 to bring them in. But remember, automatically by the time we move to 1st of January and we generate such report into the system would have automatically treat that as opening balance, right? And based on best practice, that is actually the best thing to do. The best thing to do when you are treating opening balances, if you want to treat opening balances for 2022, don't bring those balances in as 1st of January 2022. Rather, use the last day of the last financial year, and the system, would automatically treat it as opening balance for the new financial year. The reason why we do that is this. It's simply because, right, at that 1st of January 2022, if you use 1st of January 2022 for your opening balances, right, there might be one or two transactions that you would be needed, to post also for 1st of January, that same 1st of January 2022. Let's say a customer came in 1st of January, they came to buy rather, couple of items. It's 1st of January 2022. By implication, those set of transactions that you will post, they will distort that opening balances you are posting, because the opening balance is 1st of January, and you're equally posting a transaction for that same 1st of January. By the time you generate your balance at the end of that day, right, there would have been some difference. That transaction you've posted for that day would have affected, that opening balances you've captured, right? That is the gist there. So, but you would have no issue, absolutely no issue, if you use 31st of December 2021, right? And the system would automatically treat it, as opening balances for you, right? So in this scenario, we'll be using 31st of December 2021, right? Purposely, because we just, and that is based on best practice, right? Others could use 1st of January 2022, but as a consultant that have been in this field for over 8 years, right, I can categorically tell you that the best way to go about this, right, is to use the last day of the last financial year end. So now I have selected the correct date, right, and explaining to us in detail why we are doing that, right. So the next thing is, now our ledgers are now listed, right. So we now need to be imputing the respective figures, right, into the right ledger. You see that individual ledger account is listed. Members loan, prepaid rent, staff loan, trade receivable, income tax payable, short-term loan. We have all of the ledgers, and either they will be on the debit side or on the credit side, right? Our trial balance, will definitely tell us from our uh, our trial balance will definitely tell us, right, from our class exercise. Now, the only thing we just need to do is, provided that our trial balance is balanced, we just need to be picking the figures, right? We just need to be picking the figures. Now, the very first figure we'll be picking is, plants and equipment at cost, right? And remember, this is our debit and this is our credit, right? So, plants and equipment at cost is 800,000, right? I can just search for the plant and equipment at cost ledger. Remember, is on the debit side. I would enter that. Then I have its accumulated depreciation 200,000 on the credit side, right? And this is it here. I'll just pick the next one, leasehold property at cost also, right? Leasehold property at cost is a debit entry. Accumulated depreciation is a credit entry for leasehold properties, right? And retained earnings is 950,000. So we scroll to retained earnings section, which is this. 950,000 is equally on the credit side, right? We have account receivable, account receivable, account payable, and inventory. They are control accounts, right? We'll be treating them last. So I will just color them here. We'll be treating them last. Remember, they are not very, very direct, like other, uh, what is it called? Like other information is here. So that being said, the next thing is prepaid rent here. We paid rent 168,000. Okay. So I can easily search for prepaid rent. Prepaid rent is equal on the debit side, 168,000. Right? Short-term loan on the credit side, 1 million. So let me equally do Control F here, right, to easily search, just to make sure. So it's on the credit side, 1 million. Then we have our banks, right? Senate Bank PLC. So Control F again, search Zenith Bank on the debit side 750, Bank, right, 510 on the debit side equally. Sterling Bank 35,000, moving so fast. Okay, and cash in hand 1,000. That's done, right? Now we can as well, if we say, oh, okay, we have share capital 50, so share capital be treated as owner's contribution. So now remember, we still have three items to be that's left, right? Now you see that our opening balances, because this is not yet balanced, and you see that there's a thumbs down, in red here, simply means our opening balance is not yet balanced, right? There is still, so if you are working, if you are practicing on your own, when you are done with the opening balance, check, this status, this subtotal here, and the system will give you where the difference, if you have a difference, and you see that there's a thumbs down in red, and that is due to this set of three items that we are here to treat. So I would easily treat them now, right? So let's look at our account receivable. Where do we have our account receivable, right? Look at our account receivable here. It's called trade receivables here, right? And you see that unlike all other ledgers, we are not allowed to directly input anything there. It's not just a ledger, it's a control account, right? So to do that, to input, our balance, for receivable, we will need to click on add customers, because I stated earlier that that ledger balance is not enough, but your customer's individual balance would go a long way, right? So what we'll do here is to input our individual customers balance. You see that this screen is down peculiar to customer opening balances, right? So I will just copy from here. The system is asking that what is the trade receivable amount on your trial balance. What is the total amount that you have on your trial balance? Is 1,000,000, 50,000. Then I will come here, input. You see that there's a thumbs down icon. So that is because we are here to enter the individual balances for these customers. Now these are the customers that we've listed, right, in the system. So what I will just do is to pick, with respect to their individual schedule, right? Bakers Nigeria Limited is owing us 200,000 as at the last day of last financial year. So I'll just come here to say Bakers. That's this is Bakers here. 200,000. Okay, that being sorted. Noble Drilling Limited is owing us 100,000. I'll come here. Where is Noble Drilling? This is Noble Drilling. Line 3, and it's there. West Atlantic is equally owing us 100,000. I'll copy it. So West Atlantic last on the list. Paste it here. One moment. Paste it here. We have Progress Limited owing 500,000. Right. Progress Limited. Paste it here. And the last is Conco Limited, 150,000 too. We have it there. So now let's now see if our individual schedule would balance up, with our receivable balance in our TB, right? And you see here now, we now have a thumbs up. It simply means we are good to go, right? And the next thing to do here is to save. But if, let's say, I want to eradicate this, right? You simply see that there's a major difference, right, between the balances. There's a difference between the balances here, and that's why there's a thumbs down. So you need to ensure that your balances, your balance, your individual balance, and what you have on your TB balances up, right? So the next thing I'll just do here is to save. It simply means with that I've treated my customers' balances, right? And that is how beautiful it is when you are using an accounting system, right? So now the next thing will be we treating suppliers and items, right? Then we will now see if our opening balance will tally, right, at the end of the day. So I will move to doing my vendor, right? Okay, so please keep dropping your questions, right? I'll be tweeting them just shortly. So now I want to easily move to, the vendors. So this is the vendors balances, right? Same way, suppliers opening balance, right? So the same way I want to enter the balance here, I will just scroll down to my trial balance again. What's my account payable? 450,000. Okay, so I would enter that here. Of course, there's a thumbs down already. So individuals balance, vendors balance, where are they? Greenwell Nigeria Limited, 100,000. So where is Greenwell? I have it here. Opening balance, have it imputed, 100,000. Okay, done. IAC Finance Limited, this 50,000. Where is the IAC? This is it here. Okay, done too. Wadoye Nigeria Limited, 100,000 as well. The last, paste it, right? So you could type it in, you could paste it, right? I find pasting much more easier because I have them, and it saves, it saves me more time, right? That's why I'm just copying and pasting. So now we have a thumbs up. It simply means we are good to go as well, right? We click on save. Then we treat the last control account here, which is inventory, right? So you see inventory opening balance here too. Still there's still a difference, right? Here, right? So let's do inventory and let's see if our difference, will be eradicated at the end of the day. So here now, we move back to our trial balance, right? Where is our inventory? Okay, this is inventory. This is the value 336,500, of course, right? I'll paste that in. Okay, so done that. Individual inventory. Now, when it comes to inventory, it's quite different, right? For customers and suppliers, remember what we were just after, what we were looking at is just the balance. We are just picking and dropping the balance. But then when it comes to inventory, two things needs to be considered, right? The individual quantities of those inventory. As at that year end, you need to have counted, your inventory to say, oh, I have 10 quantities of this, 5 quantities of this, right? Now, for individual items that you've counted, quantities is not enough. You need to equally ascertain your costs, right? You need to ascertain your costs, and that is where, of course, your inventory valuation comes to play. Different organizations have different cost valuation method. Some uses FIFO, first in, first out. I know a couple of us with accounting background understands that. Some use weighted average and the likes. But then you need to ascertain a cost price, a cost price for individual inventory item. Because what you're after is you are needing the cost and the quantity. When you input these two, a very good accounting system would arrive at the value for you, right? And that is how it works. So here we are considering quantity and cost. You just saying you have 5 quantities is not enough. What is the cost for those items? How much are they bought for, right? That is why you see that for inventory it's quite different. And please note, when you are talking about inventory opening balance, it is only, primary, to items that are physical in nature. It is only primary to items that are physical in nature. You don't treat opening balances for service item. Note, it is only those items that you can see and you can count. Those are the items that you treat opening balances for. There's nothing, there's nothing such as treating opening balances for service item. Please have that noted, right? Having said that, let me easily treat, the items here. Now, same way, we have individual items here. Remember, I said we'll be making use of two fields. We'll be making use of the opening cost field and the opening quantity column, right? You can see opening cost, opening quantity. And at the end of the day, the system will use that to arrive at its value, which is the total column here. So let's treat from item, okay, we have item 2 here, which is prawns. For prawn, we have 10 units at 4,000 naira. That is the unit cost of that item. And the total value of prawns, if we are being asked, is 40,000. Units times cost would give you, the item value, right? So for prawns, we have 10 units at 4,000 naira, per unit. So this is prawns. So this is the cost, 4,000, and the quantity here is 10. They are good to go on that. You can see that the total value is 40,000. Let me zoom my screen a bit. You can see that the total value here is 40,000. So the system would automatically treat it itself, right? So let me zoom out a bit so that, yes. Okay, so we've treated that. So the next thing to treat is the second item, which is Coca. 20 units at also 5,000, right? So Coca, this is Coca here, right? 5,000, 20 units, and we treat crabs is 10 units at this amount, right? Crabs 10 units at that amount. So opening quantity is 10, and that is the cost. So catfish 20 and 1,000. Okay, catfish 1,000 is the cost. So please, you need to be very, very careful. You don't. It will be so wrong of you to mistake, costs and quantity. No, please always identify which is cost and which is quantity. Because imagine a case where I'm saying my cost is 10 for prawns and my quantity is 4,000. No, that would be so disastrous. So that is why systems is all about garbage in, garbage out, right? So please always ensure that you are very, very careful, right, when dealing with transactions or opening balances with, a system, right? So lobster is 20, at 2,000 naira each. Okay? So remember, the cost we are talking about here is the amount that we bought it for, not your selling price. Not your selling price. Don't let confuse the two, to each other at any point in time. So 15, right? Okay. So that is done. Okay. So having said that, if we scroll up, you see that we now have a thumbs up in blue. It simply means our individual schedule, is now in line with our value on our trial balance. You can be asked. So that is how it works. So now let's click on save, right? And let's now see what our opening balance screen looks like now. Okay, so individual balance. Okay, so now we now have a thumbs up, unlike before, right? We now see that our total debit side is 4.2 million and our total credit side is equally 4.2 million, and the whole thing is now balanced. Now if you're practicing and yours is not balanced, then note it's either you've imputed, an amount in a wrong column, something that's supposed to be on the credit side, you must have entered it on the debit side. It could be a cost, or the amount in question. In a case where you are supposed to type in 950,000 naira, let's say you imputed 95,000. So it could lead to a major difference when you are practicing on your own. So always endeavor to check, right? To check it very well. And when dealing with opening balances on any software at all, you just need to be very, very careful and look at it again and again and ensure that what you've done is okay. Because mind you, you might not even know that what you've imputed is even wrong, right? You might even work around the figures and your trial balance will still be balanced, right? But then the challenge will now be whenever you are now generating reports, it could be 3 months down the line, 2 months down, you now be saying, why is this customer's balance wrong? Must have probably interchanged, customers' balances, customer A's balance for customer B. So you will now be seeing, why is our system saying customer B is owing us this amount when he's not owing? It could come from opening balances. So that's why you need to be very, very careful to when dealing with opening balances. So on this note, I will click on update and continue, right? Update and continue. Okay, update, and that's, with that, I've been able to treat, my opening balance. And that's all you need to know about opening balance basically, and that is how it works. So now if we generate some couple of reports in the system, we would have them, right? Simply because we don't have those opening balances. Is just an accumulation of previous transactions that we must have done with respect to a customer, a supplier, with respect to our bank balances and cash balances, some of our liabilities, our assets, and also with respect to some of our inventory items that we have. So let me now take a couple of our questions, right? So we have a question from Oluwadare saying, in a situation where the trial balance is not balanced, can we treat suspense account? Well, suspense account is just is like when you use a suspense account, to balance up anything, it's just like you are preserving. There's a problem at hand, right? But then you don't want to solve the problem. You are only using a temporary approach. Mind you, your suspense balance, your suspense account will still be having some balance that you still need to clear off. So you can do that, but in practice, that is not the best approach. Unless you just want to do that to just, have that opening balance or that, trial balance done for that period. But with respect to audit, it's a no-no. Suspense account, it's a no-no. It's always been flagged. The best thing to have for you to have done is to look for where that error is coming from, right? Look for where that error is coming from and pass necessary adjustments. But if you use a suspense account, it's just like you are saving your problem for the later. And the more, you know, the more you still have accounts and the more you are posting transactions, the more difficult it will be for you to reconcile, in the nearest future. So that is how that works. Yes, suppose GT is our banker and also our customer. We sell goods to them. Do we sell GT Bank up or the system as our customer? Yes, you set GT Bank in your system as a customer and as a bank. The amount you are having in your bank, it belongs to you. You know, it's not only activity that relates to GT Bank that is there. So there will be, you would create your bank account with them as a bank, and you would equally create GT Bank as a customer. They are different, right? They are different line items. Your customer will be totally different, from your bank or your cash. So there are even instances, right? And that's where the beauty of accounting software also comes to play. There are instances where you could be dealing with someone in capacity of the customer and equally deal with such, company or such individual as equally your supplier. Do you understand? You can buy from them and equally sell to them. So when you have instances like that, you have them created as customer and equally have them created as supplier. When you buy from them, it's supplier related transaction. And when you sell to them, it's customer related transaction. It works like that. So that's how that works. So having done that, right, we will now move to the next thing. Now we've now onboarded our software. Now what we've done is we've created master file records, we've set up our company. Remember, we've bring in opening balances, right? We now want to move to transactions. The beauty. So this is where we'll be looking at different dynamics in the business world and how they will be classified and how they will be treated when you are using an accounting system, right? Be it Sage Business Cloud accounting software, be it Sage 50C, which is Sage 50 Cloud, be it Sage 200 Evolution, Sage 300 ERP, Sage S3, Microsoft Dynamics, QuickBooks, they work similarly. The interpretation of these transactions work similarly. So now the very set of transactions we'll be looking at, is our suppliers related transactions. Before we'll be able to sell, yes, we have some quantities on hand for items, right? And we have customers created into the system, right? But before you sell, practically, right, you need to have bought, right? You need to have bought from your suppliers, right? And that is why we'll be treating in this scenario, we'll be treating suppliers related transaction first. And remember again, when you are dealing with, vendors, when you are dealing with supplier, the module that is responsible for that, is majorly your supplier module, right? Anything you want to do anything relating to suppliers, you'll be doing that with respect to your suppliers module. And remember, again, the module is segmented into list, transactions, and reports, right? List, section will be used when you want to create a new supplier record, or you want to edit or update a record, right? While sub transactions, this is where you go to when you want to do transactions, right? And then, of course, when you want to generate reports, you go to the report section, right? So what we are doing now is to treat our suppliers transactions holistically. So we'll be looking at how do we treat purchase orders in the system, what is the purchase order and the likes, how do we treat invoices, suppliers returns, why the need for suppliers returns, in what scenarios would you be raising suppliers returns, or in some software they call it suppliers credit notes, right? In some software they call it purchases returns, right? We'll be looking at that, in this section that we are diving into now. Please just be sure that we can hear me, and we are on the same page. So I just need you to just acknowledge if I can continue. I just want to be sure that my audience are really getting the information I'm passing across. So please just okay. Thank you so much, Victor. Thank you, Emmanuel. Thank you. Okay, so I will just move ahead, right? So now we are treating suppliers, transactions, and let me just run us through, some of these transactions, so that by the time we start practicing now, you'd get, why we are doing couple of things. So just a minute, please. Okay. All right. So when dealing with suppliers in a typical business scenario, right, we have what you call suppliers purchase order. In fact, that is where the whole thing starts from, right? Suppliers purchase order, invoices, returns, and the likes. So we'll be treating suppliers purchase orders first. Now, what would warrant a supplier's purchase order, in the first place? The way it works in a typical business scenario is this. Let's say Droidedge Consulting, right? We need to procure, a couple of things. Let's even say for the purpose of the training. Remember, it's a seafood company. We are dealing with prawns, catfish, crayfish, and a couple of other things like that, right? And we needed, to stock some of the things, some of our items, because the reason why we are stocking is we want to be able to meet up with customers' demand when they want to buy. Or we notice that, oh, since December is far approaching, it's our peak season, right? Let's stock enough, items. So what we will do is to reach out to our vendors, to our respective vendors, and we can call them to say, oh, we'll be needing this, and this. Please, can we have your quotation? How much you'll be willing to sell this set of items for us, right? The supplier would send a quotation. They will send their own quotation to say, oh, this is what we have in stock, and this is the amount we'll be able to sell, or will be willing to sell to you. We can look at that quotation and say, okay, they've sent a quotation for 100, units of 100 pieces of prawns, right? We can look at it and say, okay, I think it's best we go for 80. So if we want to go for 80, they have sent us their quotation. So what we'll be doing is, okay, for us to now to be able to give them, we need to give them an instruction document, to say, yes, we've looked at your quotation. You can go ahead to supply us this set of items with this specific quantity. That document, that instruction document, that we, will be sending to our suppliers in this case, is called a purchase order, right? And it's called a purchase. So when we now need to raise a purchase order within the system. We can send it to our suppliers via mail. We can print it out, sign it, do all sort of things. But then we are sending to our suppliers to say, supplier so and so at this agreed, amount, right? So that is an instruction document called purchase order. But then one thing you need to note is this: a purchase order, right, does not have accounting implication. on any software at all. A purchase, when you raise a purchase order, right? It doesn't mean your books are affected or the system will say, oh, you bought those items. No, because a purchase order is not really a transactional document per se. Is an instructional document, because this purchase order you are sending to your supplier could end up not delivering all those items. They could even not honor it at all. Do you understand? That is why it doesn't have, you know, implications in your accounting system per se, right? So it's just an instructional document. So in that scenario, we want to raise a purchase order. We want to send a purchase order to our suppliers, right? And let's now raise the purchase order together. So I'll click on purchase order, and here, the way the system works is this. On this screen, on this supplier purchase order screen, if I have any purchase order that I must have raised in the system before, the system will list it out for me, right? And I will be able to see the status for those ones that have been invoiced, and for those ones that are still pending, or for those ones that are still, or those ones that are due. Maybe they are being tagged as overdue, right? I would have them listed here. So, but then for the purpose of our practice, right, I will be raising a purchase order, right? Always note there's a difference between a purchase order and a supplier invoice, right? There's a difference. The difference is a purchase order is just an instructional document, but an invoice is saying that the supplier might have delivered. You understand, in some cases, but then a supplier invoice is saying that you are indebted. By you raising the supplier invoice, it simply means you are now owing that supplier. And in most cases, it would have been that the supplier has delivered what it is that we want to buy from them, or they've rendered their service to us, right? But then let's take it one step before the other. So let's quickly raise a purchase order, because of time, right? So now, okay, now looking at the purchase order, now let's make a reference, to our class exercise at the same time, right? So now we have what we call inventory purchases and payment to supplier during the year, right? We have here items that were purchased. So we are tagging it as, before we purchase an item, we want to start by raising a purchase order. you know, uh, in some scenarios, it could be you could raise invoices directly, right? But then if typically it normally goes from purchase order, to suppliers invoice. So let's raise this line item, this one, and two line item, right, as purchase orders. Then we'll then proceed from there. So now the supplier in this case is Greenwell Nigeria Limited. So we want to raise a purchase order, you know, to Greenwell Nigeria Limited. Now, as at when we are raising this purchase order, the system is saying we are owing Greenwell Nigeria Limited a sum of 100,000 is outstanding. And where is that 100,000 coming from? It's coming from the opening balances that were posted, right? So that's there, right? So that's for that date. Okay, the next thing is the date here. You know, the moment you select the supplier, all its information with respect to address, phone number, will be displayed here, right? So, but then this section of the screen, this top section of the screen, is called the document header. The document header where you select the supplier, the date, the address, and the likes, is called document header, right? So just note that. So now, purchase order being the first purchase order we are raising the system is start. The document number is PO001. Fine. Now, what is the date? The date, see, when working with accounting systems, one of the most important thing you need to be aware of, right, is the dates. Dates are very, very important. A wrong date, used in any such document would lead, to a wrong report. So when dealing, on accounting systems, the thing, the most peculiar thing you should look out for, in any screen at all, is the date. Ensure you are selecting the right date at any point in time. So now the date for this transaction is 2nd of January 2022, right? So now I can choose to type it 0201, right, 2022, and I can choose to just select it from the date icon here, right? Okay, so I haven't done that. Okay, I want to select. Now I am done with the document header. I've selected the supplier's name. I've selected the right date. The right address is there, right? If there's any need for modification, I can choose to modify the address here. So it simply means the address of the supplier. So the next thing to do is to now fill in the document detail part. We have document header and document detail. Document header has to do with, the information there encompasses all what you have in the detail, right? So the detail, we want to be able to select individual item, right, that we are procuring. So here we want to buy 10 units of prawns, at the rate of 5,000 naira. So I would come here, we have list of items already. So I will just select prawns, right? How many quantity? 10, right? At what amount? At 5,000 naira, per unit. So I'll just type in here 5,000, right? And so now, a beautiful question was asked yesterday, and which is, how do we treat VAT in this case? Are VAT already marked up with prices before now, right? Or there are instances where we still need to calculate VAT after imputing the cost for any item it is that we are dealing with. Now, accounting systems majorly have provision for the two, right? And same thing is applicable in the business cloud. Now you see there's a checkbox box here saying use inclusive amount. When working with systems, you have two types of amounts, inclusive amount and exclusive amount. What are the difference? Exclusive amount is saying that the amount you are imputing, right, does not have elements of VAT in it yet. We explained what VAT is, in depth to us yesterday, and when VAT is to be considered, right? So in this case, right, the VAT, right, the value added tax here, you know, has it been included in the price? For exclusive amount, it is no. It simply means if we impute 5,000 here, you can see what we have here is exclusive amount, EXCL. If we include 5,000 here, it simply means there is no element of VAT in it yet. So the system is expected to compute VAT, additionally. So that is why if you move, you scroll to your right here. If I scroll to my right, you see that I have exclusive amount to have been 50,000, which is 5,000 in terms of cost times 10 quantities, gives me a total of 50,000. And the system now additionally calculated 7.5% of that amount as my VAT, right? So I have 50,000, I have a VAT of 3,750. So the total here is 53,750. So you need to ask yourself when you are dealing with these prices. And if you don't know, let's say you are a junior officer in a firm, you can always ask your line manager, can always liaise with your senior colleague to say, this amount, is it, inclusive amount or exclusive amount? Right? I explained what exclusive amount is, which is this, right? Now, you see that the total amount is 53,750, right? Let's treat this as an inclusive amount. Let's see what we would have, right? Let's treat that 5,000 naira we have as inclusive amount, and let's see what the total will be. So I will take this to say use inclusive amount, right? And I will come back here. Remember, if we are saying the 5,000 inclusive simply means there is VAT in it. So the original cost is there, and the VAT element is included in that price we are stating, right? That is the 5,000. Now you see that this has changed to INCL just by checking this use inclusive amount, right? So if I scroll to my right here, right, I will be seeing that my exclusive amount is now 46,511 and my VAT element. So the addition of the two gives me the total of 50,000 naira, right? Which is the total inclusive amount, right? I hope we get it. Exclusive simply means the price you are stating there, does not have VAT element in it. And when you say is vatable, here, because you have this column called VAT type, can easily state if an item is vatable or it's not vatable, right? The system has that flexibility. So if we are saying it doesn't have any VAT. If it's no VAT, then there's nothing such as inclusive or exclusive because there's no VAT. So the amount will just be amount. But if you are saying there is VAT on it, right, that is when we need to consider inclusiveness and exclusiveness of amount, right? So now, for the purpose of this training, I will just treat this, as the 5,000, being exclusive, right? I'll treat the 5,000 as being exclusive, and the total here is 53,750. So as a recap, we understand that the amount, although this is what we'll be paying to the vendor, right? But in reality, it is this 50,000 that the vendor, is literally getting, like, that is what is going to them as their own revenue. Do you understand? But then the 3,750, they will be paying that to FIRS, right, which is the federal government, right, as VAT, because they don't own it. Just a little recap, right? So let me just treat the other two. So for the same document, we have Coca 50 unit at 7,000, right? So select which is the next line. So Coca. So you can have two or more items. Is it 50? Yeah, 50 unit at 7,000. Same thing is still exclusive amount, right? And there is VAT on it. So it's 3,000. Sorry, the whole amount is 376,250. So the total document, you see that the system has now separated the exclusive amount, the VAT element, and the total, right? And once I do this, right, I will now proceed to my action button. If I want an additional message to say, oh, please tweet this, or what have you, or payment term that we want to pay them, or want to tell them, oh, please know that on invoices, or when you deliver, we told anyone, you can always use this message section, to input your message here, right? So we've raised the purchase order. Now we've entered the purchase order rather. So let's now process. Now the action button, when it comes to say business card accounting, is save. So it could any of these four, buttons are action buttons. So if you save it, simply means you have finalized that, record, and you want to, progress in doing another thing. Save and new simply means you've raised that information and you want to raise another purchase order, right? So print preview simply means you are still processing that you've processed that information, but you want to be able to print it out. Then email, gives you the room to send this purchase order to the vendor via email directly, even from the system. It's that automated, right? So for the purpose of the class, I will do save and new, right? Because I've processed that purchase order. This purchase order have been processed. So I want to raise another purchase order, as we have it in our class exercise, right? So I'll be doing that. Yes, you can make the date automatically. When you are raising a transaction in the system, mostly it will be defaulted to today's date. So that is why you need to be very, very watchful. But remember, we are posting transaction as far back as January 2022. So that is why we have to change that date there, right? That's just to answer that question there, right? By Abraham. Yes, Agatha asked that how did you get to segment where you posted the trial balance? Yes, it's actually under the opening balances, right? It's under the opening balances screen. When you move to the company tab, you see opening balance, right? You see opening balance. So that's the screen where you get to treat that. Okay, so to quickly move to the other purchase order. So the other purchase order is for the same date, but a different vendor. So that is Finance Limited, right? So I'll select that as Finance Limited. So remember, is equally, sorry. So remember, is equally 2nd of January 2022, right? So just to move fast. So we are buying 15 units of crab at 3,000 naira each. Okay, 15 units, sorry, 15 quantities of crab at 3,000 naira each. It's equally vatable. So the next thing is catfish 20 units at 1,100. So catfish, right, 20 units at uh 1,100. Okay. That being said, then we want to do save, right? So remember, save and new and save, they still work alike. So we've raised two purchase orders and you see them here, right? So now, for us to treat the third one, right, we'll be treating the third one as we progress to the next phase, which is inventory, which is supplier's invoice. Now we've raised the purchase order, and you can raise as much as many purchase orders within any system because it doesn't affect it doesn't affect your item, it doesn't affect your suppliers, it doesn't affect anything at that point. So when you raise the purchase order, do not be bothered, right? And when you make mistakes, you can always, choose to delete the purchase order and, raise the correct one. But even when you make mistakes on purchase order, there is no, it doesn't have any effect. It doesn't show on even your supplier's statement. Okay. So now we've raised our purchase order, right? Let's now say that this supplier in question have delivered, right? They've delivered this set of items, right? And when they deliver, right, it's it's the best thing to do is to raise a supplier's invoice, right? Is to raise a supplier's invoice, right? Some systems will treat you raising a goods received note, then a supplier's invoice. But Sage Business Cloud Accounting treats the two together, right? It's only ERP systems that will separate good received notes for inventory team and supplier's invoice for the finance team. But when it comes to, Sage Business Cloud Accounting, when an item or when a service is being rendered, right, what you do is you raise a supplier's invoice, right? So that purchase order that we've sent out, right, let's take it like the suppliers have now supplied, right? So supplier invoices those two things, right? It does two things. And the things that supply invoices does is when you raise a supplier's invoice, it increases, the quantities of items you have on hand. When you raise a supplier invoice, the system will automatically increase the quantity of items you have on hand by that quantity you have on the supplier's invoice, and also recognize, the fact that you are indebted, you are owing the supplier at that point, unless and until, right, you raise a supplier's payment. Note, when you raise the supplier's invoice, because what we are looking at here is an accrual reporting system, right? So this system would always, consider that you are owing the supplier by you raising a supplier invoice. So when you convert a purchase order to an invoice, it is until then, that the system would recognize that you are owing a supplier. So let's just move quickly because of time, right? Now, and when you are doing a supplier's invoice, you can either convert, an existing purchase order to an invoice, or you raise an invoice afresh. So, it could be either ways. Now, so what we will do is we will convert these two documents, to supplier's invoice, and we will raise, this third item as a fresh invoice that is not having a purchase order. Do you understand? So it could either be both ways, right? So now you can raise a supplier's invoice from the purchase order screen. You need to ask yourself, is there a purchase order for this invoice? If there is, you can easily navigate to your purchase order screen and click on action, right? Then from there, you will see create invoice. So you see create invoice here. So the system is saying the purchase order status to be changed to invoice. So click on OK, and the system would open the supplier's invoice screen. You see process supplier invoice just like we have here, right? So another thing you need to consider, just like I said, is this supplier correct? Fine, it's correct. What date did they deliver this item? Because it's not the date of your supplier's invoice, of your purchase order now. You might raise a purchase order in January and the supplier delivers in March. So it is the date that they delivered, right? That is the date you'll be imputing on your supplier's invoice, because it is that day that you start being indebted to them, right? So it's not the date that you raise the purchase order, but the date they delivered, right? So, but for the purpose of our class exercise, right, it was considered to say that the date of the purchase order is equally the date they delivered. But it's that's not the only way it works, right? In real business scenarios, the thing you should consider is what date did this supplier delivered this item, right? It's the day they deliver the item or they render the service that you'll be recognizing on the supplier's invoice. So what you just do here is, remember, just like I said, the date has been defaulted to today again, right? I will just change this, right? 0201 2022, right? And move on. So now these are the items. You will always have instances where you raise, just like you should have 15 quantities, right, on the purchase order, and the supplier ended up delivering 10. Maybe they want to deliver in piecemeal. So if you find yourself in that scenario, what you do is you just input 10, yeah, you know, because it is the exact quantity that they deliver that you will be entering. That is the exact amount or exact quantity or exact value that you are indebted to, right? Not the total quantity that is on your purchase order. So some people make that mistakes. They make such mistakes. So as a person that has attended an accounting software training, you should note that it is the exact quantity that was delivered that will be considered, right? So if 10 is being imputed here, simply means 5 is still outstanding, which they might deliver later, right? But for the purpose of this training, let's still leave it at 15, right? And you need to consider, does the price still stand? Because there are times where, when your supplier would send you their own supplier's invoice, right, for the delivery that they've made, the price might differ there. They might tell you due to exchange rate fluctuation and the likes, the amount has increased due to market price and all that. So, but we are still maintaining the same price in this case. But if it changes, always remember to update it, right? Update it before you process. So we've done this. We've ensured that our date is correct and our supplier is correct, right? The next thing we want to do is to click on save and new, right? And just like I said, you can choose to convert a purchase order to a supplier invoice, from the purchase order screen, right? And you can equally choose to raise a supplier invoice and then select the purchase order, that is related to that supplier invoice. Now, what I did firstly is to convert from supplier's invoice screen. From supplier's purchase order screen. But now let me now raise this invoice now, you know, by not going to that screen because I have the luxury to do that. Now I want to convert the second, document, which is for DIC finance. So I'll just select DIC finance, right? And ensure that I'm selecting the right date, which is 02/01 2022 as well. Right? And here from purchase order, from which purchase order, right, are you doing this supplier's invoice? So if there's any purchase order for this supplier, if there's any assigned purchase order, I can select it here, right? And once I do that, the system would automatically update my document detail here. And you see, is the quantity still remaining the same? And is it at this price? Yes, it is. Right. If I confirm that that's exactly what is still live, I will just go ahead to just save and new again. It simply means I've processed that second document. Then let's now raise the last document ourselves, right? Because remember, there are no purchase order for this last one. Let me just raise it from the invoice directly. So Panotion, right? 2nd of January. Sorry about that. So 2nd of January, let me just select here. No purchase order. You see it's blank, right? So let's just impute Lobsters 10 units. Okay, Lobsters 10 units at the rate of 5,000. That's what they just delivered to us. So I'll do that. It has VAT on it too, right? 53,715 total, right? And the next thing I need to do here is to say I'm not creating a new document. I would have done save and new. But let's even see. Let's print review. Let's even see what our purchase order, what our supplier's invoice rather document looks like. So this is what the document looks like. You can see This is our logo here. This is supplier invoice here, and you see the document dates. Right, this is our address. This is the document number, supplier invoice 3. This is the supplier invoice date, right? There is no discount on it. This is the supplier that we are raising it, for Panocean Nigeria Limited. See the address here and see the quantity that they delivered. Lobsters, 10 quantity at this amount, and see VAT on it, right? And everything equals 53,750. And this document, I can always choose to save it as PDF. I can export it to PDF. I can print it to my printer. I can send it via email, to the suppliers directly, or to my superior, or to anybody, right? So I can choose to export it as an Excel file too. So if I want to export as an Excel file, I just need to select Excel here, right? And I would export, right? And I can equally choose, to save it as an image file. So whichever one I'm pleased with, I can always do that, right? So that is how that works. So what we've done is we've raised the purchase order and we've raised suppliers' invoices. But you will see that our suppliers' invoices are reading overdue. Simply means they are overdue for settlement. They need to be settled, right? And it's three of them, right? So that is just how. And with this, if we check two reports, if we check our suppliers transactions report or supplier statement, you will see that these invoices that we've raised have affected it, right? And if we equally check our item, be it inventory movement, be it item valuation report, you see that our item would have increased, by this supplier invoice that we've raised, right? And that is how it works, within a system. Always remember, a supplier's invoice document, would always affect your financials. So it's always important you pay much attention when you are doing such transaction. You could have several purchase orders. It doesn't have financial implication on your business, but a supplier's invoice has series of financial implications in your books. So you need to note that, right? So now, having said that, businesses is not all about roller coaster, right? There are also scenarios that would evolve, that would want you, to raise this next part that we are going, and which is suppliers returns. In some softwares they call it suppliers credit notes, right? So in say business cloud, accounting software is called, suppliers return. In what instances do we get to raise these documents? What would happen, to allow us to raise such? Remember, two scenarios could always happen that would warrant you to raise a supplier's credit note, as it's been called in some system, or supplier's returns, as it's been called in, say, business cloud accounting software, or, purchases return, as it's been called in, another set of software too. Just to be sure we are on the same page. Okay, so I just ask the question: in certain period dates, are we to wait for the goods to arrive before starting delivery? No, 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 no. The delivery date is, you should have an estimated time that you think they will deliver, or that you think the PO would be honored. So we are raising this purchase order to say that, okay, we believe in the next 2 weeks it should be honored, so we can set our delivery date to be 2 weeks. That's just to answer that. And Victor is saying, please take note, the supply invoice, okay, was double. Okay. Oh, fantastic. Thank you. Yeah, yeah, yeah. It's. Thank you for correcting that. Thank you for bringing my attention to that. Yeah. So I will correct that now. Okay. So final notion. Okay, okay. We are supposed to have, Greenwell Nigeria Limited, somewhere there. Okay, now this leads us to the next. Exactly, it's a typical scenario that could happen. So it could even happen, to you as a user, when using the system, and that is what will lead us to what we call suppliers returns. You know, Now suppliers returns does two things. I will correct that part of supplier invoice now, but because of where we found ourselves now, so it explains the scenario for suppliers returns better. Remember, suppliers returns, you would always raise it in two scenarios. Number one, the fundamental scenario where you would use to raise it is this. It's possible that when a supplier should supply, you know, you could have instances where part of what they've supplied is damaged, right? Or that's not even what you requested for. You requested for a certain specification and they didn't meet up to it, right? Or you notice that some of the items are damaged and you want to return. Let's say they supplied 50 quantity of an item and five of it were damaged. So you want to return the five. In that scenario, right, the document you need to raise is called supplier's returns or supplier's credit notes, as it's being called in some systems, right? Or in some systems, they call it return to supplier. So that is, the typical one of the reasons that could lead to you raising that such document. You just returning it physically, to just say, oh, you've returned it to the supplier is not enough. You need to also, factor that in your software, because anything you are doing in physical needs to be replicated in your software. Else, you would have discrepancies. If you have items that you bought and you didn't do a supplier return within the system, when items are being returned to your vendor, it simply means the quantity you have in your system will be much more higher, right? While what you have on hand will have reduced because you've returned. So when such scenario occurs, you process the supplier's returns, right? The second scenario that would warrant such is this: a supplier's return or a supplier's credit note would always be used as a reversal document for suppliers' invoices. You see, there are some systems that do not allow you edit transactions, or delete transaction when it's being posted. Most especially bigger systems, they don't allow you. And when such scenario occurs, right, note that the supplier's returns or return to suppliers is being called in another system, or supplier's credit note as is being called in another system, would always serve as a reversal document should you wrongly raise a supplier's invoice. So you can be asked that when you raise a supplier's invoice, in error, maybe by selecting a wrong supplier or by selecting a wrong date or by selecting a wrong set of items, in a system, what document would you raise to correct such? It's simple. You raise a supplier's return document or you raise a supplier's credit note document, right? To correct, because when you raise it, and remember, when you are doing that in this second scenario, you need to ensure you select the same supplier that you selected, you select the same date, and you select the same set of items you want to reverse, right? But it's just that this is, giving you the right hand feeling, the second one is giving you a left hand feeling, and the supplier's return would erase, would net out that supplier's invoice. So those are the two instances, and I need you to note that very carefully, right? I need you to note that very carefully. So in this scenario, now, St. Business Cloud Accounting Software allows you edit transactions. Should you make mistakes, but then you could even be restricted. Just like I was explaining yesterday, that you can always control user assets. So now the way we normally work around this is this: mostly you wouldn't allow junior users or to edit transactions, so you can give the right to maybe a superior user, right? So now in this scenario that we've raised, two invoices. The first invoice is supposed to be uh, for Greenwell Nigeria Limited. So what I will just do is to do this. I can choose, you know one moment. Okay, so I can choose to edit this and hold on. I can choose to edit. Let me see. uh, Copy invoice, no. Let me edit. I can choose to edit this, to the correct, which is going well. And when I do that, then I will need to update the purchase order on it. So we only have prawns and coca, so I need to remove this. Okay, so comes and cook out 2nd of January, which is right. Then I can just save. Okay, so now let's see what we have. Okay, we now have the 3 sets of invoices going well. That okay, fine. So that is that. But when you want to raise the supplier returns, all you just need to do is to go to supplier's returns on that supplier, add a supplier return. Remember, I said it will be used in either of the 3 instances I listed, right? And in that instance, you just need to select. Let's say you want to return a couple of items that going well, sold to us. Now, the return date, as at what date, are we returning the item? Remember, we bought it 2nd of January. Let's now say we returned, couple of items on the 5th of January, 2022. We've seen that, some of those items are damaged and we want to return it. But we didn't return it at the same date they delivered it. Now we are returning it on the 5th, right? We just select 5th of January, right? We should be correct. The date should be correct, right? So we'll do that. Then we can easily link it to an invoice to say, okay, it's from this invoice. Then what is the quantity that we are returning? Let's say we are returning, 2 from here. The same amount will still be applicable. The only thing you will be changing is your quantity. And let's say that our coca, 5 also we export here. We can just do that. But it's not what you are returning is not the whole quantity. It's just the quantity that you've returned in reality, right? That is in this first instance of damaged items, right? And when you do this, you do save, right? And that will be all. Do you understand? But you need to ensure the correct supplier was selected, the correct date of the actual return was selected, right? And the correct item and the correct quantity that was returned were selected. And you click on save, and that will be all, right? But then, if it were to be a total reversal that you want to do, simply because probably the document does the software does not allow you edit, in some systems. So what you need to do in this case is you would ensure they are the same quantity, the same day, the same supplier, the same amount, everything should be the same. So that's just the major difference between the 2 scenarios. So what I would do here is just to save. Remember, we are considering that 2 prawns, were returned. Then, of course, 5 quantities of the other item, were equally returned. So that would just be the only thing we'll be treating on supplier's return, because that is how it works, right? Then we will then move to supplier's payments, right? Sorry, I'm moving. We need to move fast, because of time, so that we can quickly. There's still much to do ahead, and so that we can just move very, very fast. Okay, so now we want to move to suppliers payments. Okay. Okay. So there is no clarity. Okay, please confirm if you can hear me clearly before I move ahead, please. Please confirm if I'm audible, if you can hear me, and if you can see my screen. Okay. Thank you so much, Victor. All right. Okay. Okay. Thank you, OVA. Thank you, endowment. Okay. So now let's look at suppliers payments. All right. So suppliers payment, we've looked at purchase orders, we've looked at invoices, we've looked at suppliers return. So when would we raise suppliers payment? Like the name implies, suppliers payment. Whenever it is that you make payment, whenever you make payment to your suppliers, in reality, you are expected to raise such, a transaction in your system as well. That's the implication of that supplier's invoice we've raised, is that we are owing that supplier. Now, the implication of the supplier's return is to say that those items that we raised that are returned will leave our warehouse in the system, right? And the amount we are owing our supplier would have reduced. If you sell to me 10 quantity of an item, that means I'm owing you 10. If I return 2 back to you, automatically it simply means I'm now owing you for 8, right? That's the implication of that supplier's return document. That is in the case where the return is as a result of damaged items, right? So now suppliers payments, when we are now making payments, we need to raise it in the system so that the system doesn't just be the system won't be carrying any balance that doesn't exist anywhere, right? So this is equally important. So we raise suppliers payment when we make payments to suppliers, right? And let's now say, let's rely back to class exercise. Sorry about that. Okay. Okay, so let's easily relate back to our class exercise. Here we say we have suppliers vendor paid during the year. So we have a couple of suppliers that we paid during the year, right? We have Greenwood Nigeria Limited, DIC Finance Limited, Pan Ocean Nigeria Limited. So let's do well to treat Greenwood Nigeria Limited. Greenwood Nigeria Limited was paid on the 12th of January 2022, right? And they were paid via Zenith Bank, and the amount is 450,000, right? So I would go back to my software. Here in my software, I'm raising a supplier. So you can see the screen. Let me zoom my screen a bit. So this is supplier payment. So here I'll be selecting my supplier, right? So the fields that needed to be filled here, firstly is the supplier. So you select the supplier, which is Greenwell Nigeria Limited, right? Then the next thing is, how much are we paying, or how much did we pay? We paid 450,000. So we just repeat the amount here, 450,000, right? So is there a reference? Was there a payment voucher, right, raised with respect to this, or was there a check number? So a reference is just that additional or supporting document, right, that you might have with respect. It could be your bank payment reference or any reference at all. So you can just include it here. So I would just say, let me say this is a PV. It's just anything that you can easily trace that transaction to, right? It could be an instruction, it could be anything, it could have a reference pattern in your firm, right? So it's not one way, right? You can have several reference methods. So the next thing now is, which bank was this money paid from? So which bank, you need to know, right? When the payment is being made to a vendor, you need to ascertain which of the banks. Is it from cash on hand? Is it from petty cash? Is it from a particular bank account? So you need to select the right, bank account that money was paid from. So with respect to our exercise here, it's being paid from Zenith Bank, right? Which is 450,000 naira. So what we'll just do is to enter Zenith Bank here and enter the description. The description of for that payment is always good. A very good accountant, a very good software or bookkeeper who should always enter well and meaningful description, right? So that when you want to reconcile your books, it makes it very, very easier for you, right? So now let's look at let's just say payments, right, to green well payment to going well. Let's just use that as a description, right? And at what date was this money paid? It was paid on the 12th of January 2022. So we'll just come here. You can easily type it in, 1201 2022, right? Then what payment method? Is it through electronic phone transfer? Is it through cash? Is it through check or credit card? Let's say it's we pay through electronic phone transfer. We can just select that there. And we've done the needful here. The next thing would have been to process. But then you will notice we have a section here called unpaid invoices. Now, there are instances where we might know, if the set of invoice that amount is meant for, right? You can just allocate it here, which takes us to the next action, which is allocate payment. A very good accountant, a very good bookkeeper, when you are making payments, you need to ascertain which of our invoices have we paid for, and you allocate appropriately, right? The essence of allocating is to say that whenever it is that you are generating report, you can easily know the set of invoices that are outstanding and the set of invoices that you've settled, right? I know in some business scenario it is very, very hard to ascertain, but if you are in such scenario, you can leave it. But if you are not, you can always reconcile. You can always allocate. So now we pay 450,000. Look at the set of invoices we have. There is a particular opening balance. We can choose to assign and say, oh, this amount, from this 450,000, we settled our initial opening balances of 100,000 here, right? And the remaining amount is going to our supplier invoice one that we have here, which, the balance, the remaining balance, which is 350,000, is settled. We settled it on an invoice. If we can have set of invoices, but we need to ascertain this money we paid for, which of the invoices, the only thing that allocation does is to help you ascertain, the set of invoices that you've settled and those that are outstanding, right? But it is not compulsory, but it is very, very good. It's not compulsory you do it, but it is good you do it. So you might be called upon to say, oh, let's even see the amount we are owing these people. And you, as a good accountant, you want to know the ones you settled and the ones you've not. So when you do proper allocation, it helps you know those outstanding, such document that you need to settle at any period in time, right? So when you do that, you can click on process. You know, you can easily click on process and new, right? So that explains, suppliers payment. So I will just easily do the two, without explaining much. So now the next is GAC finance. So I'll just come here, GAC finance, right? uh on the 8th, I can just select the date here, 8th of January 2022. We paid, let's say we paid via cash. Let's just, leave it as that. We paid via Zenith Bank 100,000. Okay, we paid via Zenith Bank 100,000, right? Zenith Bank 100,000 is the amount. So reference, let me say this is PV002, description, let me just say payment to that is C. So let me just leave it as that. It could be anything, So we set to the opening balances. Okay. Set to the opening balances. I can choose to take this back as cash, just like so. We set to the opening balances of 50, then the remaining amount, was for this. So process are new. But if I still do not allocate, it still doesn't affect me, right? It still allows me, do the needful, right? So 1901, that's for Pan Ocean, right? Pan Ocean, okay, no one, how much? 200,000, okay. So it was paid from GTB, and the reference is, let me say, it reference, 3, and meant Pan Ocean. Okay. So I haven't done that. Just select, and if I choose not to select still, for you to know that it will still work, I can just choose to do process. But it's just that, imagine if I go back to my set of supplier invoices here, I will see, those ones. Look at, we've paid for Pan Ocean, but it's still reading overdue simply because we've not paid at all. But we've paid, but we didn't allocate. Do you understand? So that's why, it's always good you allocate. But these ones that have been partially paid, you can say partially paid, partially paid. That's just the purpose, for allocating. And if you, let's say you want to allocate later, let me allocate for Pan Ocean. I can go to my allocation screen to allocate. Right? I would click on Pan Ocean here. Now I now want to allocate. At the point of posting, let's say I did not know the invoices that we were settling, right? But then I now know. So I can choose, I can go back to come and allocate to do refresh here. To my left, I have invoices, right? Like as you can see. And to my right, I have unallocated item, which could be payment or return to supplier. So now, which one is outstanding? So opening balance is outstanding. So I can just drag here. Okay, I can just drag from here to here. Okay, what I want to treat is 200,000 and just save. So what I've just done is to just allocate, my payment to my invoice, and basically those are the set of transactions you have when it comes to suppliers, and those are the set of scenarios you could have too when it comes to business scenarios, right? And the other scenario we have is suppliers adjustment. We won't be doing much of that, but the only time when you'll be doing adjustment could either be, let's say you are doing end of the year reports, right? And there's need to now adjust the suppliers balances. Oh, we've reconciled, or you've reconciled your books. You now saw that, oh, this supplier not owing us this amount, maybe it's due to when a couple of invoices, or your supplier overcharges you, they give you, a debit, sorry, a credit note and the likes. So you can always use supplier adjustment, because your adjustment could either be an increase to increase the supplier's balance that you are owing them, or it could be a decrease. It could be either ways, right? That's what you do. You use supplier adjustment for, right? But supplier adjustment is only in some scenarios. It doesn't happen all the time. It's only, some scenarios. It only happens, just like those scenarios I've painted, right? So because of time, we won't be doing much of suppliers adjustment. We won't be doing much of suppliers adjustment, but we just need to note that suppliers adjustment, could either be an increase or a decrease. And what are you adjusting? You are only adjusting the supplier's balance, the amount you are owing your supplier. And so many things could lead to that. It could lead to, after reconciliation, you've seen that, oh, this supplier's balance we are carrying is not correct, right? So you could do a supplier's adjustment as advised by management, anyways. You could do a supplier's adjustment to correct whatsoever thing you want to do. So that's just how that works. So now those are with respect to suppliers. Uh, yes. So those are with respect to suppliers related transactions. So there's a question here for me from Matolade that says that I should recap on some systems not allowing editing of transactions. Yes, systems, accounting systems out there. Not all systems allows for editing transactions. Let's say you've posted an invoice, you now notice that, oh, I selected the wrong supplier. Oh, the wrong date was selected. Some systems would allow you edit, such as the systems that will allow you edit. Tally, Tally is a system that will allow you edit transactions. You know, say business cloud accounting software, if you have the right, would allow you edit transactions. QuickBooks Online would allow you edit transactions. Then, you know, QuickBooks Desktop, if you are using the accountant edition, it allows you edit transactions as well. But if you just the QuickBooks Desktop, it doesn't allow you. So now another system, and so some systems does not allow you now in entirety. Systems like say 200 Evolution, doesn't really allow you. Say 300, Sage S3, right? They don't allow you edit transactions, and couple of other bigger systems. So majority of all these bigger systems do not allow you edit transactions. So they won't allow you edit. Once you've posted, and that's how it goes. So for you to correct that wrong posting, you need to raise a reversal document. So when you raise an invoice in error, you raise a credit note to reverse it. When you raise a credit note in error, what do you raise? What do you raise? I'm sure you must have been wondering. When you raise a credit note in error, you correct it with an invoice, right? Because they are like words and opposites. A credit note is an opposite, to an invoice. And when you raise one in error, you correct it with the other, right? So that's how it works. So when you raise invoices in error, you raise a credit note to correct it, using the same information on the existing document. Then it is the other way around. I've seen instances where a user raised an invoice in error and they were trying to correct it with a credit note, but then the credit note he imputed, he still made an error, on the credit note, still went ahead to select a wrong date. Do you understand? So now you now have two wrong documents, and we needed to reverse the two. So that wrong invoice, you still need to create, a credit note to correct it, that same wrong credit note that you raise in error, you still need to raise, an invoice to correct it. So to just to nail it out. That's how it works. So that's how tricky it is, right? And you just need to note that. So we just move forward, and please confirm again if you can still hear me and if you can still see, my screen clearly. just to ensure we are on the same page. So because we want to quickly move to supplier customers related transactions. So we move to customers related transactions. Then after we are done with that, we now move to banking. How do we treat transactions with related to our banks, our cash and cash equivalent? We want to post expenses. Oh, this voucher, how do we do it in the system? And most importantly, how do we do bank reconciliation? You could be hacked. There are so many people, yes, they've read about a software, they've used a software, but can they do bank reconciliation? No. So now those are the next phase that we'll be moving into now gradually. But please confirm if I'm audible, right? Okay. Thank you so much, Ovie. Thank you, Amarachi. Thank you, Victor, for that acknowledgement. Okay. So now we've bought items in our system, right? What do we do? Those items, we are not to just consume them. Some of them could be used for consumption, internal consumption, which is normal, right? But then what we want to do now is let's now say that customers are now walking in. We want to sell to customers. How do we go about it? And how do we treat it on systems, right? Would go about that, using the customers module, right? You go about that using the customers module, right? And now, you know, for the customers, remember, it also starts from list. We've created our customers. If let's say customer is walking in now, what we need to do is let's confirm if the customer is being created in our system yet. We don't just create customers. You need to search. You need to confirm, right? That this customer, have we been dealing with them before? Let me search before you create. Always avoid duplicate records, please. Always search, confirm. You can be asked that when you want to create a customers within the system, what do you need to do? Right? The very first thing you need to do is to search if such a customer does not exist. And you have several ways of search. You could search by using the customer's phone number. You could search by using the customer's name. If you search, for instance, let's say your customer's name is Aziz Adeomi, right? If you search using Aziz and you can't find it, right? Search further using Adeomi. You could find it. It could be whoever that created that supplier mistakenly spelled Aziz. So one thing you want to eradicate is having duplicate records, right? And your customers could be, based on businesses, customers, the way you create customers differ, right? There are some customers that in some business, maybe it's a store, right? And you have so many working customers, right? Probably they are not your regular customers, but they just working. You could have a customer created called working customers, and you raise invoices in their name and payment, and that's all, right? But if you deal in the kind of system where you create your customers within, you can always go to the system, search first. If you can't find it, that is when you should, then create. So now we are not looking at creating because we've created yesterday. So what we are looking at is set of transactions. And what will warrant all of these transactions, right, with respect to a customer. The very first thing is called customer quotes, right? A quote is called a quotation, right? So just like we looked at it from the supplier's end, right? As a customer, you understand? Just like we looked at when we are dealing with our customers, right? Our customers could call us to say, "Oh, please, do you guys have this so, or do you guys render this service? If you do, okay, please, can you send us a quote?" That is what a quotation is, right? The document you raise, notifying your customers to say, we can provide this service, or we can do this, we can supply this for you, at this also amount, is called a quote. Quotations, you could call it estimates, right? But note, when you raise a quote, it doesn't have any financial implication in your system. You can raise as much quote as you want. In fact, if your customer should ask for 5 quotes, you can raise the 5 quote and send to them. It doesn't affect anything. So when you make errors when raising a quote, it's no problem at all. You can always go back to raise the correct one, right? So it doesn't affect anything. It doesn't have any implication in your books, right? That is what a quote does. It's just like, it's the opposite of purchase orders when it comes to supplier, right? It's the opposite of purchase order. So now, that's what a quote does. So because we won't be dwelling much on quotes. Rather, we'll be moving to invoices. Remember, quote does not affect anything, but then it is until when you supply an item or something to your customer, that is when, or when you've sold, basically, that is when you raise an invoice, right? But you see something in between. There's a document called a sales order, right? What is the difference between a quote and a sales order? They are similar to an extent, but they are still different. Now, a quote, you send a quote to your customers, notifying them to say, this is a set of service that we can render to you at this amount, right? That's fine at that stage. So they can now look at it and say, okay, they are okay with this. So they are expected, right, to send you what you call a purchase order, their own purchase order, saying, okay, oh, with respect to the quote that we've received from you, this is our own PO, right? So this is what we now want you to supply at this amount. Do you understand? They are sending you their own purchase order. So when they send you their own purchase order, it simply means they are ready for business, right? Now, when you have that, you can now raise something called a sales order. Do you understand? The purchase order is coming from your customer now. It's not your own document. But what we tag as your own document, what we serve as your own document, is a sales order. Now, a sales order is saying, okay, we want to actualize this sale. Or these people are committed to say they want us to supply this thing. So you can raise a sales order to book that, within the system. So when you raise a sales order, someone knows that, oh, there's a sale that is about to happen. That's a sales order. Do you understand? So, but then the sales order does not carry enough weight, because tomorrow the customer could even say that, oh, they are no longer patronizing. Do you get? So the only document that carries enough weight in this instance is a customer's invoice. When you've now made that sale, when you've rendered that service, that is when you can now say, okay, yes, we are sending in an invoice, right? And remember, and that is where I'll be starting. This their screens are similar, right? Their screens are similar. It's just that the function that they perform is different. I'm talking about quote, sales order and tax invoice. So I'll be starting from tax invoices because of time, because our time is fast spent already. Wow. Okay. So for tax invoices, okay. So now we'll go back to our uh, class exercise, right? But you note one thing earlier when I was dealing with customer payments, sorry, suppliers payments. I am not sure I treated this last part, and I purposely left it out. Right? I purposely left it out because I will show us the reason why I left it out, right? As we proceed when we get to the banking section, right? Okay, so having said that, we have you can see invoices and receipts to customers during the year, right? So we want to raise invoices, because of time. To raise invoices, you click on add a tax invoice. Now note this again. Note this. An invoice document signifies a sale. When you make a sale and you want to recognize revenue, the document you raise then is an invoice. Or even if it is written manually, you see that invoice you've seen is saying that you've sold or you've rendered a particular service. And by doing that, you've done what we call, you've recognized revenue. For you to recognize revenue on a system, the document you raise is a customer's invoice. So you've recognized revenue, and that revenue you've recognized is also translating into your receivable at that point. Now when you sell to a customer, if the customer have not paid, it's a receivable, right? So that is why I said what it is a revenue would equally translate to a receivable for you, right? And if the item has to do with inventory, right? Remember, your item will be reduced, and when your item reduces, it goes, that portion of your inventory that reduces is equally going to affect your cost of sales. For some of us are accountants understand that part, right? And if it has VAT, of course, VAT would also be treated just from that document called invoice. It is very, very powerful, so you need to be very careful. So let's raise invoices here, right? Now, invoices signify sales, and we have invoices for West Atlantic. We sold 5 units of phones to them on the 3rd of January. So now West Atlantic have it selected. The date, the correct date still needs to be selected. 3rd of January 2022, so 03/01/2022. Okay, done. Yes, so 5 phones were selected, were sold at 5,000, right? So now you have the date. The invoice date is very, very important. The date you sold is very, very important, right? You know, if I'm selling today, if let's say I made a sale yesterday, but then due to one or two things, maybe I couldn't raise that invoice as I was raising it today. It's not the day that you're raising the invoice that the document date would carry. It's the date the sale was made. Even if the invoice was for last month, you would impute last month date because it is the period that you've selected. That is the period that sales, that revenue, would account, will be accounted for. Do you understand? So please, the date is very, very important. And the due date here is simply saying this invoice that we are raising. If the customer is a credit customer, if it's the customer that we normally have an agreement with, say, okay, you can pay in 5 days time, you can pay in 10 days time, or at the end of the month. That is when due date will then be important. The due date is simply saying when are you expecting that this invoice will be settled? So here, based on our own policy, we are saying it is the last day of the month. It could be the same day. If it is the same day that this invoice is cash and carry, so it simply means our due date to be 3rd of January 2022 is as due, when we raise it, right? So that is how important that part is, right? So now we fill the document header. So let's now fill in the detail. So they bought 5 prawns at 5,000. So now I will select an item prawns, right? 5 at what price? At 5,000. Okay. So I have done that. 5 prawns at 5,000. And remember, there was a payment also being made, but we'll treat the payment part, later. But let's treat the set of invoices first, right? So now we sold 5 units at 5,000 naira, and we've selected that. Remember again, the thing also is this item that we sold, is it vatable? Because you need to note in your organization now, or where you might be applicable to work in future, all their items or all their services might not be vatable. Do you understand? All the items, all the set of services that they render might not be vatable simply because there are some items that federal government has, automatically excluded to have been vatable. Let's say it's a store, and you sell a couple of things. Your pharmaceutical product, for instance, will not be vatable, so you need to be very careful. If it's not vatable, what you do is to select no VAT. Yeah. But if it is vatable, you select standard rate. So you need to confirm from your senior colleagues or from your management if to know those items that are vatable and those ones that are not. And the interpretation of this is equally that if it is vatable like this 5,000, is the amount, does it have VAT elements in it already? If it has, remember what you use is inclusive amount. But if it doesn't, what you use is exclusive amount. Remember, I explained that earlier. So you need to know, because whatsoever it is that you are doing here affects your system, it affects your books, it affects your balances, right? And note, a very good and correct information will lead to a very correct report. And likewise, that's how it works. So now, for the purpose of this class, we are saying that our 5,000, this item is vatable, and our 5,000 is exclusive of VAT. So it simply means the system will still compute VAT on it, right? And that, which is what we have here. Right? The VAT is 1,875. And also note, you see, in actual sense, what is coming to us as revenue, as our own sales, if you record that, yes, we truly have sale. Do you understand? Is this 25,000? But this VAT element, right, we are to pay it to federal government. So the way it works is to offset it with, the VAT that we've incurred when we bought. Accountants in the house, or if you have an accounting friend, they would explain, much more better to you. Or those that are accountants understand this that I'm explaining, right? So, but then the 25,000 is your revenue, but you see that VAT element is not necessarily your own, right? So as a business person, when you make a sale and you have VAT element on it, and you are saying, oh, I've made this total amount. No, 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 no. That's not, in actual sense, that is not, the total amount that you've made. You see, this amount is not your own. It's going to the federal government. So that is how it works, right? After you must have offset it, of course. So now, so I have done this. I always ensure if what you've posted is correct, right? West Atlantic, yes, the date is correct. So what do? I can choose to print preview, to print it, to see. And I can choose to just do save or save and new. So if I do print preview, I've processed it, right? That's how it works. And I can now print out my document, or I can send it, via email, or I can print it as PDF or as an Excel file. Should I, which way so if I want to export it as PDF, have that been selected, I'll just click on this my save button here, right? I'll click on my save button, and you see that the system has automatically downloaded it as a PDF file for me, right? And I can attach it to my mail, I can print it out, I can send it to my superior or to another department, as it works in your company or in your firm or in your business, right? So that's that on invoice. So now let me raise a couple of other invoices. We have okay, so we have on the 4th of January, we sold to Progress Limited 20 units of coca. So add a new tax invoice. Okay, so Progress Limited, 4th of January, so 0401 2022. Sorry, Progress Limited, we sold 20 units of coca. Okay, 20 units at what price? 9,000. Sorry. Okay, still vatable, right? That's the only thing we sold coca, right? Remember, each document, each invoice is peculiar to a customer and is specific to a date. So it doesn't work like Shebi, we sold on the 4th, on the 6th, and on the 8th to this customer. You can raise one invoice now. No, it's not. You don't do that. Do you understand? You don't do that because you would want, by accounting practice, by bookkeeping practice, you want individual invoice, to relate to the dates at which you make those sales. So you need to separate the sale you made or as at on the 4th, separate it from that of on the 6th. Do you understand? So that their revenue would report, independently. So that you see, if you are generating daily sales report, you see what you've made. But in some companies too, they give room for a couple of those to say, okay, Shebi is 3, but it's how best it works in your firm. But then the first option, is actually the most primary, option. But then let's move ahead. So you would input this, that's done, then we'll just save. Okay, so then James Balori, rather, on the 15th of January, is the next one. Okay, so James Balori, have that created yet. Okay, so one thing we can do is this. Now, we don't have James Balori here, right? So rather than going back to list to create our customer, the system equally has a functionality called create on the fly. So we can equally from here, from the drop down, you see add new customer. Let me zoom in a bit so you see it. So you see add new customer. So it simply means you can add a new customer, in the system, right? So now to create a new customer, rather than I don't want to leave this guy, I can just come here to say add new customer. So what's the customer's name? James Valori, right? Okay, paste it here. What's the category? It's our regular customer, so we say trade debtor, right? What other information do we want to keep with respect to James? Do we have his email or phone number? If we don't have it, then it's still fine. Then we can just click on save. Okay, so remember, just set this to print because we don't have an email for James. Or better still, you can set this to print an email and just enter an email here. But if it doesn't have an email, then there is need to change this statement distribution. I explained to us yesterday to just print or none, right? So I haven't done that. We don't have any address, no problem. Just click on save. We've added James as a customer, right? Is that easy, right? So the next thing is what date? 15th of January. So 1501. We'll go for a break shortly, please. Uh, Once we are done with customers, now we'll go on the break. They will now treat banking. They will do bank reconciliation and look at a couple of other things as well, right? So we'll soon go for a break. James Balodi, uh, 15th of January. So the item here, they bought 11 units of at 10,000 of ice block. So ice block, right? Uh, 11 units, 10,000. There is VAT on it too, right? So then we can just click on save, right? So we can just click on save, or better to save and new. There's still okay. So now those are the set of invoices we have with respect to our class exercise. So we've been able to raise these invoices, but then we have been told, right? Line item 4 is saying on the 20th of January, rather line item 5 is saying on the 21st of January, West Atlantic returned all 5 units prawn, right? They returned. It could be due to, let's say, they found out that the prawns were bad. Do you understand? So they returned. So in that instance, what would we raise then? We won't be raising an invoice again then, right? But then there is a such document we'll be raising. And what is that? We'll be raising what we call customers credit note. You see, customers credit note is just the opposite, of what we explained in suppliers returns. Now, customers credit note is equally raised in on two occasions, right? The very first set of occasion is when an item is being returned by a customer, right? Be it due to it being damaged or any other reasons that they must have stated. That is one. You raise a customer's credit note. Then the second option why that could happen is if if you find out that an invoice that you raised was raised in error. So you can use the customer's credit note to correct or to reverse. No, not even to correct now. To reverse. That's the right word. To reverse, the earlier raised invoice. Right. So, right, in this case now, where we have West Atlantic returning 5 units of funds, so what we do is to raise a customer's credit note. Have that noted, right? Credit note is a reversal document for invoices, right? Likewise, invoices is also can also serve as a reversal document for credit. So just note that, right? So now we are raising a credit note for West Atlantic as at 21st of January. So we select West Atlantic here as our what date? 1st of January. It needs to be accurate. So when we do that, right? So the system is equally saying that this credit note we were raising, was this as a result of an invoice? Was it coming from an invoice? So to make it much easier, we can either choose to start entering the item that they return here, right? Or we just map it to the invoice that it is applicable to. And when we select it, the system will automatically, pick up the details you have on that invoice, and it makes it much easy. So we now need to note, okay, we need to check, yes, it was found that they returned. How many quantity were they? Okay, we sold 5. How many quantity did they return? Okay, they returned all the 5. Fine. So this quantity still remains 5. But in a situation where if what they return is 2, what would impute is 2, and the price still remains the same, right? And what we will just do here is to save, and you might print preview, or you might even print it to send it to your customer to say, we've recognized, or we've treated this set of items that you've returned. Do you understand? And we would have it like that. So that is how it works in a system, and that is how you go about that, right? So let's just before we go on a break, let's just get to the part of customer receipt, right? That will give us a leverage point, for when we come back. So it's pretty simple. Customer receipt is straightforward. It's just like what we've treated with respect to suppliers payment. You can see the screens are similar, right? So just on a quick one, the first one is 3rd of January, 2022. West Atlantic paid us, 25,000 naira, and they paid into Zenith Bank. So we'll just come here, select West Atlantic, right, which is the customer details. Then we'll input the receipt details. They paid 25,000 naira, right? And reference could be, let me just say receipt 01, where did they pay into? They paid into Zenith, right? Have that been, we select that. So let me just say, because of time, let me just say being payment received, right? Because of time. So date is 3rd of January, right? 02, sorry, 02, 0301 2022. So did they pay via transfer or via cash or check? Let's even say it's check, Let's just select that. Then we can allocate, just like I mentioned. So we are allocating to this, their open balances. And what we are doing, okay. So I need to confirm something here, but then let's process this transaction. So let me confirm customer invoice to West Atlantic. Okay, it was the funds, and yeah, we treated the returns. That's fine. So then the next thing is, Progress Limited paid into Zenith Bank, and they paid 9,000 naira. No, they paid 120,000. So Progress Limited paid 120,000. Customer receipts, don't forget. So Progress Limited 120,000, right? And they paid into Zenith Bank. So the bank that was being paid into Zenith. So let me just say receipt 202, right? Let me just say payment because of time. Okay, let me just tag this as electronic fund transfer. And let's say, that's 120 is actually on this amount. Okay, so let's process and new. James Balori paid 110,000 on the 15th of January. 110,000 on the 15th of January 2022, right? So they paid cash, right? So it simply means they paid into, cash in hand. They paid, via cash. So now that's well noted. So let me just say payments, because of time, right? And allocate it to this invoice and process and new. Then lastly, Progress Limited paid 460,000 of its outstanding balance to Zenith Bank. So we come back, or better still, let me also, just like I've excluded this, because I will show us why I did that, right? We'll be posting them, in when we get to the banking section, right? We're posting them when we get to the banking section. But these two, we have a supplier payment that is outstanding and the customer payment that we'll be doing too. So now, I haven't done that. I'll click on okay. So that's all for that. That's all for customer receipts, right? And that's basically how it's been treated uh, in the business world, and how you treat it in, say, business card accounting software. So let me see. Okay, do we have to add the VAT in suppliers delivery and customer invoice and remit to FIRS or what? Yes, if let me see, in suppliers delivery. Okay, delivery note and customer. Yes, if what you are dealing with is vatable, of course, you need to add, the VAT element. But note, the way it works is this: the VAT, when you are buying from suppliers, right? Let's say the total VAT you incurred in a month, in the month of January, let's say is a total of 50,000, or let's say it's a total of 50,000, right? And when you sold for that January, you know, uh, when you sell in that January, you sell, the total VAT that you realize from what you sold is 70,000 naira. What you will do is this. You know, we always have an element of VAT input, VAT output. The VAT that you incur when you're buying from your supplier is the VAT input, and the VAT you charge when you sell to your customer is VAT output. So you would always do VAT output minus VAT input. So the VAT you charge your customer, right? You would always, before, because all the VATs that you realize, let's say is a total of 7,000. You are not just paying that total of 70,000 to FIRS. No, right? You firstly, before you remit, you would need to remove that total of 50,000 naira with respect to VAT alone, just VAT that you incur when you were buying, those set of items. That VAT element of 50,000, and you remove it from 70,000, because you need to sort yourself first. Because the VAT element is to be paid by the final consumer. Even when you are paying the VAT to your supplier, right, at the initial stage, you are still going to offset it. You will still remove it. It's still your customer that will still pay that element of VAT. So now you remove the 50,000 from the 70,000, and you will have a difference of 20,000. So it is that 20,000 naira that you will be remitting to FIRS for that month. So that is how VAT works. You remove what your supplier has charged you that you've paid, from your money, right? You deduct it from the total VAT that you've charged your customers, and the difference is what you'll be remitting to FIRS. So that's how it works, right? So it is on that note. If you still have any question, you can drop it. But it is on that note that we'll go on a short break, so that we can stretch, our legs, find something to eat, and because of time, let's go on a let's because we still have much to do. Let's go on. We can go on, say, 10 minutes break. you know yes, it's short, but let's just try to manage it so we can learn as much as we can from this section. So let's go on a 10-minute break. This is 2:22. So it simply means we'll be resuming back, or let's resume back by two. Let's resume back by, that should be 2:32, right? Let's resume back by 2:35, please. 2:35, right? By 2:35, we'll be resuming the section, and there's still so much more to learn. So I look forward to seeing you in the second, part of the training, right? So thank you so much, for the time, right? And can't wait to see you by you know, uh, 2:35, please. Thank you so much. Okay. In the class. So welcome back again. Okay. So let me start by uh, answering. We have a couple of questions there. So that is asking. Yes, the software does it automatically. So that VAT input will be recognized when you are raising your supplier's invoice. That VAT element at the point of raising the supplier's invoice, it automatically amounts to, VAT input, right? And of course, whenever you are raising the customer's invoices, that is when VAT output, would equally be recognized. So those invoices that will be raising, those VAT elements that you are seeing there, is the VAT output. And the system automatically even aggregates it for you. The system would do the difference. The system would complete the two and give you what it is that you are supposed to get to your regulatory authority at the end of a certain period. Right. Okay. So please confirm if I'm still audible, if you can still hear me clearly, so that we can proceed. Right. So confirm you can hear me clearly. I'm audible. Uh, okay. Okay. Victor is saying yes. So who else can please hear me and if you can see me, so that I can share my screen and we can proceed to the next thing, on our agenda. Okay, thank you so much, Larry, for that. Okay, so let's get right into it. It's getting much more and more interesting. Okay, I can't hear. You can't hear me. It's breaking. Really. Okay. See. Okay. So how about now? Is it clear now, or is it still breaking? So I can change my network. So please confirm if it's clear now, so that if you can confirm, Abraham, if you can help, confirm if you can hear me. Not clear. Okay, hold on a second. Hold on. Okay, sorry about that. So is it better now? Let me even check my audio. Okay. So okay. Thank you. Fumilola is saying it's better. So please, if I can have someone else confirm if it's better. Okay. Okay. Thank you so much. Thank you. All right. So now let's move right into it very quickly, because of time. So now uh, that's actually what VAT so that's it about what VAT entails and how it works. So now we've done customers related transactions. So we've looked at scenarios that could lead to those those scenarios that we've pointed, right? And we've seen source documents that will be raised, with respect to certain scenarios that could have arise in the business world, right? So now let's proceed to the next thing on the agenda. So the next thing that we want to look at is banking, right? But before we look at banking, we've been doing a couple of transactions, right? You'll be asking yourself, what are the implications of these transactions? How will they report? even though we'll be looking at the reporting aspects, much later we'll be looking at different reports and how well we all can interpret the reports, and those basic reports that you'll be needing as a business person, as a finance person, right? Those reports that will be required of you, and even when you see these reports, how you can easily interpret them. We'll be looking at that in depthly. But then always note that each transaction will be raising, right? With customers' invoices, credit notes, suppliers, they have implications. They have implications not just on customers and suppliers' balances, they have implications on your revenue as well, your profit or loss statement, your balance sheet. And they equally have implications on your items. When you sell, by you raising customer invoices, the items reduce. And when you purchase, the item increases. Do you understand? So now let's look at banking. You know, we've been buying, we've been selling, and we've been making couple of payments, right? But then let's look at, there are a couple of other things that businesses get involved in, right? And which has to do with banking. There are a couple of other things that you make payment for. You could be asked, how do you classify these expenses? How do you raise these expenses? When this happen, how do you treat it? Do you understand? And that is where banking is very, very important, right? Now, for you to process any transaction that affects your bank, of course, aside from customers receipt and suppliers payment, which is equally available in another screen, like I had shown us, right? Another module that is very much responsible, for bank and cash related transactions is our banking module, right? We do two things majorly from the banking module. We process transactions that affect our bank and cash, right? And we equally do what we call bank reconciliation, right? We equally do bank reconciliation. So at first, what we'll be looking at is posting banking transactions. And what are those set of transactions? If I make reference to our class exercise, you see that we have a couple of exercise that we are to do there. The business had series of expenses that was incurred. We'll be classifying these expenses together, we'll be raising them together, right? And we'll be looking at a couple of things we need that you need to be careful of, right, when doing that. And we equally have a couple of outstanding transactions that we are to post, right? And I will tell you the reason why you have that. I actually single them out, right? So now let me just go back to the software. Now this is the banking screen. Let me zoom out a bit. You see, this here is what we refer to as the banking screen. And in the banking screen, we have the bank or credit card that is concerned, right? We have series of banks and cash. Most systems treat bank and cash the same way, right? Most systems would literally, you know, uh, treat bank and cash the same way, because in the real sense they are cash are cash equivalents, in nature, right? Same thing that is applicable with respect to your cash is still the same thing with respect to your cash, and it's still the same thing that would happen with respect to your cash at bank. Do you understand? You would always spend and you would always, reimburse or receive money, right? And at a particular period, there will be need for you to always reconcile those, set of cash or bank. So that is why you see that under bank or credit card there, we have both bank and cash in there. So that's because most systems, you would only differentiate it by their description to say, oh, the name of this ledger is bank, you know, is any bank, and the name of this ledger is cash on hand, or the name of this ledger is petty cash. Do you understand? But then their nature is just like their nature, the way you treat or the way you classify, those is still the same in almost all the software, right? So you have the banking screen, you have the bank or cash. Then of course, you have the transaction section of the screen. The transaction section, it has several columns. You have the date, the pay, the description, the type, selection, and I'll walk us through all of this. You have VAT, you have spent column, and you have received column. Then you have, of course, the reconcile column, and couple of other actions that you can always uh, carry out, right? So now we want to the thing you get to do under banking here is you get to do transactions, be it cash or bank, related. So now to explain it better for us, right? Let's try to process one expense, which is maintenance of bowls, right? At 25,500 that was paid to GTB. Remember, it was paid towards GTB. And it simply means, this banking screen, you can only post transactions with respect to a bank, to one bank at a time, right? Now, what I want to process here, has to do with GTB. One thing I can easily do is I can easily classify all, transactions that has to do with GTB and just process it on this screen. Just change this to GTB and just treat those transactions that affect GTB at once here, right? So to easily do that, the first transaction here is 2nd of January, right? You see, I have here dates. It allows you to enter multiple lines, right? You can have multiple lines on this screen, right? On this banking screen, you can have multiple lines. So you see that mail is selecting the bank, right? The system is giving me the current balance in that bank, right? And now what I need to do is to ensure I select the right date, for this transaction. I can choose to expand or reduce a column, like I'm doing now, right? 2nd of January 2022, right? Now the next thing is the payee. Okay, so the next thing is the payee. So the question is, who are we paying, or who are we paying this money to? Right? Yes, we want to process maintenance of bowls, right? But then the money must have been paid into someone's, account, or must have been given to someone. It could be to the vendor, or it could be, a customer that is paying money into, our bank. It could be one of the staffs, internally. So that's what pay refers to. So, but then it's not a compulsory field, but it's just good you input something there. So let's say this money in question was paid to Aziz, to disburse, right? But then we have a description. One thing you should notice: the banking screen here allows you to post both inflow and outflows. When you receive money and when you pay money, you can always use the banking screen to post. So it's not majorly for expenses that you paid for, right? It could even be used to post, refunds and couple of other things, or customer payment and the likes, right? So I've selected payee. Then I would enter my description. So my description for such expense, so I'm treating this as an expenses, right? So what's the description for these expenses? I can type it in, right? In this case, it's maintenance of borrow. It could be anything. It could be, being payment for stationaries. It could be being payment for foiling. It could be anything at all. So, but then, you know, the next thing is now the type. We have a column called type. Let me reduce this pay here so that we can, so we have a column called type. This type and this selection we have here are very important. Let me zoom in a bit so you see them very well. So type here. Remember I said the banking screen allows you to process, couple of transactions, both inflows and outflows, right? Now, the type here, we have different types of, or different nature of transaction that we could process here, right? The type here, we either have accounts, this transaction we are posting, does it have to do with accounts? What do we mean by account? Account will be if it has to do with a typical expenses or a typical liability that we are making payment for, or we are clearing. It has to do, if it has to do with our bank and any other ledger, right? We would select our type will be accounts, and you will see how that works, right? By the time we move to the selection section. So we equally have customer, we have supply, we have transfer, we have VAT. Now, if what we are posting, if what we want to recognize here is with respect to our customer. Let's say a customer paid into our account, rather than we could either use, the customer, receipt from the customer screen, right, to process such a transaction, or we could process it from the banking screen. And what would we do? We select customer, and when we select customer, it simply means our selection here, what would have would just be a list of our customers. But if I take this back, if I say what I want to post is an expense, simply means what I'll be selecting here is account, is a ledger account. And my selection here will be those ledger accounts that we have in the system, right? If I change my type here to supplier, my selection will be with respect to suppliers. And it will be instances where, let's say, I'm making payment to my supplier, or a supplier is trying to refund us, maybe we've overpaid or anything could have happened, right? And another thing is, let's say the transaction we are trying to capture is a transfer that we made from one of our bank to another bank. Remember, what you would select in that scenario is a transfer. It will be a transfer. Do you understand? But then, if what we are doing is VAT payments, let's say what we are doing is we are now making payment of VAT to FIRS. You understand? We are settling VAT. That is when we will select VAT. But the most major thing is, if what you are raising is expenses like we are doing now, right? Your type, what you would select rather would be accounts, because what you want to select is a ledger account, is an expense ledger. So in that instance, you need to ask yourself, maintenance of borrow, what does it have to do with? Does it have to do with just expenses? If the answer is yes, then note the type you select here would be accounts, right? And of course, your selection here, right? You then need to ask yourself, because that is where classification comes to play. Maintenance of borrow, where should it be posted to? Where should I recognize it to? It will be so wrong for me to post it into stationary's ledger. Do you understand? It will be so wrong of me to post it into computer and equipment accounts. It will be so wrong of me to post it into motor vehicle repairs, because you have, remember, individual ledger account is created, to accommodate couple of activities or couple of related activities that you want to account for, right? So in this case, right, a typical selection that will select here, you need to ask yourself, if you keep scrolling now, is it other income? No, it's not other income for us. Is it expenses? Yes, it's expenses. So what nature of expense is it? Is it accounting fees? No. Is that money maintenance of what spent on advertising? No. Was it a bank charges to us? No. But we have a ledger for borrow expenses. So it makes more sense for maintenance of borrow to be posted into a ledger account called borrow expenses, right? So that is where classification comes to play. So if you are in a firm, there's no big deal. There's no problem in you asking. If you are not so sure of what a classification, what you should, or a particular transaction line, if you are not so sure of how to classify it, always ask. Ask your colleague, because it's better to ask and know, right, than to process or to post a transaction wrongly. In some firms, it is very difficult to reverse. You have to collect approval. You have to, your superior or your supervisor have to be the one to reverse. And so when using an accounting system, you need to be careful. You need to minimize error as best as you can. So you can always ask, or you can always seek for accounting advice with respect to this. So what we are doing now is we are processing a borrow expense, and we just select that. Now the next thing is there a reference? Right? So any reference could be, maybe there is a supply invoice that you are trying to make settlement for, or anything could be any reference. It could be a payment voucher number that you've raised in-house. So that is what we tag as a reference. So reference is saying anything you could easily attribute, that transaction to. So when I see a transaction, I see a reference, number in front, I can easily see, okay, this is how best I can trace it. Some people, their reference is with respect to their bank and the date it is that they make that payment for. You know, some it's their payment voucher number, that they input there. So that's how it works. Then VAT, right? So this expense you are processing, is there a VAT on it? Mind you, normal expenses, even though whosoever that is, providing that service for you is charging you VAT, you are not expected to recognize that VAT. The VAT that you are, the set of VAT, that you are, or any kind of money you are spending and you are being charged VAT, you would only, recognize VAT, the VAT on it as VAT, right? Only in a scenario where, if that thing you are paying for, if it's not an item you will resell to your customer, if it's not a kind of, service you would, resell, or you pay forward to your customers, do not recognize it as VAT. You are to expense it in entirety. So let's say there is a payment, that you are trying to make. They said it's 50,000 naira, then VAT on it is 5,000, so it's 55,000. Ask yourself, this service or this payment that we are paying, right, is it such that we would resell to our customers? If it is no, if your answer is no, you need to expense the whole of 55,000. It simply means what you have here will be no VAT, right? And you would, impute 55,000 here. But if, the nature of what you are dealing with, is vatable in nature, right? You can always, recognize VAT on that transaction. But VAT is only attributable to invoices. So even this banking screen should mostly be on no VAT. Do you understand? Because VAT should majorly be recognized on invoice screens. Have that noted. But even, right, when you receive an invoice from a vendor, it could be a sundry vendor like we've classified or we explained to us yesterday, right? If we get an invoice and the what we bought, is, we don't resell it, right? Don't recognize that VAT as VAT. It's typically an expense to you. But if what you bought that you're trying to, set to in form of invoice, if you do resell it, you can recognize that VAT. So, but then you can always ask your colleagues, whatsoever, where you are working, or you can ask, consultants also, to know how you can easily classify, how you can, when to recognize that and when not to recognize. I would advise you read more or you learn more on it, as the case may be. But just for the purpose of this training, this VAT will be on no VAT, right? And we'll move on to the next column, which is, we now have the spent column and we have the received column, right? We have the spent column and we have the received column, right? So now these two, spent and receive, you could use either of the two, but it depends on what you are trying to achieve here. So the spent is saying, from this bank account to from this GT bank that we've selected here, this transaction we are raising, did we spend it from, is it a spent amount, is it going out from the bank or is it being received into the bank? That is what we ascertain, whether it will be spent or it will be received, right? So now in this case it's an expense of 25,500, right? And it will be recognized as it being spent because the money is leaving the bank. So don't get it mixed up, spent and received. The question is, what is happening to that bank you've selected? Are you spending from it? If you are spending from it, if money is living there, then you impute, that amount in spent column. But if you are receiving money into that, account, into that GTB, then the money will be received. The two, you cannot fill up the two at the same time. Do you understand? The moment you start imputing something, imputing a figure in received, you see that the spent to be cleared off. So it's just a matter of, this is what the system will use to consider if it will be debiting the bank or if it will be crediting the bank, for those of us that are accountants, right? So for the purpose of these expenses, the expenses would always be in spent column, right? And not received column. Then if it is an inflow, then inflow will be tagged as received. So before I move ahead with a couple of other expenses, right, you would recall that I purposely left out a couple of transactions here with respect to customer and with respect to supplier. Remember, I said the banking screen can be used, for any set of transactions, right? But before I treat that, let's look for other transactions. Now, this has been treated, right? has been treated. So let's look for other transactions that has to do with GTB. So here, let's see, this is Zenith, okay? SN expenses that has to do with GT Bank here. So, okay, we have another transaction here that has to do with GT Bank, which is line 6. It says on the 21st of January, purchase of table for office use. So 21st of January. So no pay is saying purchase of tables. So let me just copy from here. Purchase of table for office use. Right? So the type is still account, right? So the selection now. So purchase of office table, it's just it's not an ordinary expense to us, right? For those that has accounting background will understand that such will be treated as an asset. So we won't just table is a fixed asset, is a property, plant and equipment to us. So we'll go to the non-current asset ledger, right? And this is table. Table will be classified under furniture and fittings. So it will be fixed asset at cost for furniture and fittings, and it will be 20,000 naira. So here now, let me say ref 002. So no VAT. Yes, we spent the amount too, which is 20,000 naira. Okay, we do that, and we want to save changes. We want to save changes. Now, another thing you should notice is the system allows under the banking screen, right? It allows you, you know, for a junior user to enter transactions that affect bank, right? And a superior user, could come into the system and review such, now these postings, these entries have not they've not affected our ledgers now, because we are here to mark it as review. So now it is expected, the system is expecting that a user will come into the system and preview this to say, oh, this is right, is the account, the classification is done rightly. And it could even be the same user in a case where it is one user that is managing the system. You could just click on mark selected as reviewed, or mark us as reviewed, because you will see that the moment you see you have two transactions to be reviewed, right? So the moment you mark all as reviewed, simply means that transaction would have affected your ledger, and you'll be seeing it under reviewed transactions. All right, you'll be seeing it under reviewed transactions. So that is how that works. So we've done for GTB, right? And we would proceed to do for others. So let's see if we have any question at all, for us so far. Okay, no question so far. Better. Okay. So I hope I'm still very much audible, please. Please confirm if I'm still very much audible before I proceed to raising a couple of other expenses that affect other banks, such as Zenith Bank, particularly. Okay. So just to confirm I'm audible. Okay, thank you so much, Victor. Thank you. Okay. So yeah. Okay. So the next thing here to do for me is to raise, transactions that has to do with Zenith Bank, right? So I'll just come back here, change the bank to Zenith. Please always ensure you are posting into the right, banks. So for Zenith Bank here, I have, I would want to treat this first, which is Progress Limited. Remember, we are here to treat this. So Progress Limited as at 20th of January, 20th 2022. All right. So Progress Limited paid us 460,000. Right. So payment by Progress Limited. But then remember, this will then change to customer, because we need to be able to attribute, this payment to Progress Limited. So if we don't change this to customer, if we don't change the type to customer, there is no way our selection would, allow us select customers. And if we change it to suppliers, remember, we would only be seeing suppliers. But if we change it to account, we'd only be seeing accounts. And if we change it to transfer, we'll be seeing other banks or cash. Do you understand? So now, changing this to customer, progress limited, right? Reference, for because of time. So spent, received. Now, this time around, progress limited are actually our customers, right? They are our customers. So the money they paid, 460,000 naira, would be tagged as received. We received it into our bank. We didn't pay. It's not leaving our bank, right? So it will be tagged as received. So having done that, we want to move to the next thing, which is what other thing affects. So let me mark this as going. Let me mark it as going. Okay. So we have okay, the next set of transactions for Zenith. Okay, we have here electricity expense that was paid to Zenith. Okay, so 2201 2022. 2201 2022. So this is electricity paid for the month, right? Electricity paid for the month, sum of 30,000. So that would remain accounts. Okay, selection electricity. So you need to look out for electricity expense. So now this is what I'm talking about now. Imagine we have electricity and water and electricity expense. So it simply means you are kind of like, so this in the first place, this ledger account needs to be modified, this electricity and water, because we cannot have two ledgers for electricity unless the electricity is of different kinds, or let's say you want to have different ledger. You could want to have different ledger for different electricity expense with respect to your office locations. So let's say you have 3 offices. You can say, oh, you want to differentiate the electricity expense you are incurring for Lagos, with that of Owerri. So when you want to do that, you can have different ledger. It is understandable, but you just need to label it right. But in this case, electricity and water, electricity, no. So we'll be taking electricity expense and we'll be modifying electricity, and water, to just be water, expenses alone. So no VAT on it. Then it is spent. So this is 30,000 naira, right? We've done that. So we don't have any other transaction, belonging to Zenith, any other expense Zenith. So that's done. So we would equally just save changes and mark all as reviewed. So to have that treated. So the next thing on the agenda now is to look at a couple of other expenses. We have cash, which is 3. We have 3 of cash payments, and we have, of course, a transaction for Zenith. So let's quickly treat that of cash. Select cash now. Let me zoom out so we see the screen very well. So let's treat this first. 25th of January 2501. So we are treating, cash, and bank related transaction. So, and remember again, it's being done from the banking screen. Banking, we have transactions and we have banking, right? So that is where we are carrying this, out. So now we can say Wadoye payments. So we are treating the initial. So this is supplier. Remember the initial vendor payment we left out. So Wadoye payment paid 100,000. So Wadoye, let me just say that, so it was, received. This money was received 100,000. No. Sorry, supplier we paid rather. Yes, we paid 100,000. Paid 100,000. Okay. Oh, we paid 100,000, and okay, that's been done. Okay, the next on the agenda would be okay. We have security on the 7th of January. We have security of stations. Okay, so let me just copy this to make it much more faster. Stations and upkeep, right? So accounts, so 12,500. So security of the we can search. Okay, we have security of station expenses, right? 12,500 is still under spent. Sorry, that's 125,000. 5,500. So no VAT, please. No VAT. Right. So the next thing here is electricity paid. Okay. Electricity paid. Okay, I think okay, that must have been tweeted. Okay, that's another electricity, no problem. So electricity as at 22nd of January paid from cash, right? 30,000. So that's 22nd, 2022. Okay. So going back to my class exercise, electricity paid in cash, right? So it's equally account. And I'll select electricity expense, you know, reference 2, reference 3, this will be no VAT, right? So how much did we pay? We paid 30,000 as well as cash from cash and hand. So that then we have maintenance and general repairs, of course, as at 18th of January, right? As another, so 1801 2022. So maintenance and general repairs, of course, is still account. So let's see. Okay, we have a ledger for maintenance and general repairs. So I can just have another reference, permit. I'm just because of time, I'm just using, any reference that just comes to mind. So 5,000 naira. Sorry, 5,000 naira. So that's so we've treated, so we only have that of Sterling Bank, outstanding. So now we've done this, save changes, mark all as reviewed, that's been posted already. So then let's just do Sterling Bank and we'll know we are off and want to move to the next phase. Okay, so 22nd of January, right? Same here. Description. This is maintenance of generator sets, right? It's still an expense, so we typically select account, but then uh, the ledger account generator expense is most appropriate, right, for such. So because we want to be able to, accumulate all the amount we spent on generator, right, for a whole period, right? So that when we are generating our income statement or we are generating our income statement for the month, for the year, as the case may be, we would be able to see the total amount. So it will be so wrong. You now see why classification is right. So imagine this amount you want to pay, this 20,000 that I want to pay for generator sets. If we should mistakenly take it to electricity expense. So when we are looking at our report, we would be seeing that we've spent so much on electricity, which is not, right? So that is why proper classification is important when you are working, with a software. And if you don't understand it better, if you don't understand it that much, always ask questions. It's better off, making avoidable errors. So now 20,000 are paid through Sterling Bank, which is correct, right? I would save changes and I'll mark as reviewed. So now that is how you go about it, right? That's how you go about posting petty cash voucher, petty cash expenses, or major expenses transfer that you've done from one bank to the other. And if it is a transfer that you do, and in some cases, some organizations would typically they would withdraw some amount in their bank, and they would reserve it for petty expenses. They can call it petty cash. It happens. How do you treat such withdrawal? It's very simple in this case. You just need to select your date, input your description, be it withdrawal from bank for petty cash, or for interest and all that. Then your type would be on transfer. Remember, if that transaction has to do with two different banks, right? You select transfer, so it will literally be between Sterling Bank here and the other bank you must have selected in selection, right? And spent or received, which will be applicable, right? So it depends. If you are transferring money from Sterling Bank to GTB, for instance, so it simply means you will be imputing the amount in the spent column. You see this spent and received column. What controls it is what happens, whatsoever that happens within that bank that you selected up there, right? If it were to be that you are transferring from GTB, to Zenith, or to Sterling, what you will do is, so the money is received into Sterling Bank, then you just impute the amount under the receipt column, and that is how it works. So if you are withdrawing any amount for petty cash and you are selecting, maybe cash in hand or petty cash here, once you select it, then of course the amount will be spent under Sterling Bank. So in the back end, it simply means it's petty cash or be it cash in hand that's receiving the money. So it's as simple as that, right? So that is how you go about it. So that's been done, right? That's been done. Remember, we've processed customers' payments that they paid, to us. We've equally recognized the payment we've made to suppliers at the same time the payment we've made with respect to expenses, right? But then before we generate our reports, before we go in depthly into this series of reports that we have, right? One thing is important for you to always do as a business person and as an accountant, right? As someone who is a business minded person, and it is this: you need to always reconcile your bank and cash, at the appropriate time. So the appropriate time in some cases, is weekly. The appropriate time in some companies is monthly. In fact, the appropriate time in some companies is even daily because of their volume of transactions. So the earliest or the earlier time you reconcile this bank and cash, the better it is for you, because one of those things that is very, very critical and fundamental for businesses, is their cash and banks, right? So you can say, oh, you wrongly raise an invoice and all that. But if you wrongly raise a payment, I don't know how you want to defend that. Oh, someone made a payment that they didn't. Someone made a payment that they didn't make in actual sense. Do you understand? Cash and bank is very, very, is very, very fragile. So you need to be careful and you need to ensure you reconcile your cash and banks. So how do we reconcile? What are those things we need to look out for when reconciling, right? And how do reconciliation, how do we carry reconciliation out on systems? We'll look at that, in our next phase now. But in the meantime, let me see if okay, there are no questions for me as at now. But please help confirm again if you can hear me clearly. It's for my betterment and your betterment as well, to ensure that we all are on the same page. And of course, uh, uh, you know, things are going on, well. So, okay, thank you so much, Oluwadare rather. Thank you so much, endowment. So, all right, that's well noted. So, I will just proceed, right? So, now, how do we reconcile our banks, right? What are those things we needed to do when we want to carry out bank reconciliation? You know, and how do we do it on Sage Business Cloud Accounting Software? All right. So let's get right into it. Now, to do your reconciliation, you should remember that bank reconciliation always have to do with your banks, then in cases and your cash in hand. Right? Why are you reconciling? You are reconciling because you want to be sure that what you are carrying in your books, right, in your software, is in line with what you actually have on hand or what you have in your bank. And it is also because there are so many things that could have happened that could have led to discrepancies between the two. You could have in your system saying I have 50,000 naira in GTB, but in actual sense you might be having 47,000 naira in GTB, and the earliest you are able to reconcile it, the better it is for you to know where the difference might be coming from, right? So how do you go about that now? So to do bank reconciliation on Sage Business Cloud accounting software, you still make use of your banking screen, right? And when you go to transactions, what do? You go to reconcile banks and credit card, right? You want to reconcile your bank and cash. That is how easy it is, right? And remember, if you go back to your class exercise document, you will see it says that post all transactions, required post all transaction into Sage Business Cloud, right, and generate various financial statement reports, right. It also says that also prepare bank reconciliation for Zenith Bank. The bank statement balance is 774,500, right. They gave us a bank balance. So that's for you to note that when you want to do a bank reconciliation, you need particularly you need your bank statement. You need your bank statement. It could be in Excel format, it could be printed out, but then you need your bank statement for the period you are reconciling for. It is very, very important. You need your bank statement for the period that you are reconciling for, right? So in this situation, right, we are assuming that we want to reconcile for Zenith Bank for January. So it simply means when we want to do bank reconciliation, we need our bank statement for January, because there are a couple of things that we'll be needing there, right? Number one, we'll be needing our opening balance, you know, for the 1st of January on that bank statement. Remember, we explained in the early part of today's class, I explained the difference between when you hear closing balance and opening balance. So you should know that when we talk about opening balances for January 1st, as at January 1st, 2022, you should know that that opening balance is as a result of the closing balance for 31st of December, 2021, right? So that is the closing balance. But then it's forming the opening balance, because what we are looking at now is the opening, of the new month or the new financial year, as you might put it. So we needed those information, right? Now, we needed information as to, so on this bank reconciliation screen, just a moment, please. Okay, on this bank reconciliation screen, what are we reconciling? We're reconciling for Zenith Bank, right? From which period to which period do we want to reconcile for? Right? From which period to which period do we want to reconcile for? Okay, I can see, I can see something here that there's a particular transaction that I have raised in error here, and which is there's a receipt for Progress Limited, right? That I raised using 13th of November 2022. So let me quickly correct that. So it's customer receipt. Okay, customer receipt. Progress Limited. Okay. Here we have it. It ought to be in January. Remember, State Business Cloud, accounting, uh, allows you to edit transactions. So what we'll do here is this. Okay, it has been allocated already. So let me unallocate it. Firstly, because I've allocated, let me unallocate that for Progress Limited. Refresh. Okay, customer receipt 4. Okay, customer receipt allocate. One moment, I'm just trying to unallocate so that I'll be able to edit, that receipt. So go back to customer receipts. Okay. So here we have it. So the correct date ought to have been, let me see, progress limited. What's the amount? 120,000. So this should be here, 4th of January, right? 4th of January. Well, I was able to note at the point of reconciliation, anyways, and that is one of the reasons why reconciliation is very, very important, right? Okay, so let's go back to our reconciliation screen. But in the meantime, please, I need you to just spare me a minute, right? Spare me a minute, I want to ensure my device is charging. Just a minute, please. Okay. All right. I'm back. All right. So now, okay. So let's just go back. So now we are trying to reconcile, of course, our Zenith Bank account. And the moment you select Zenith Bank account, right, you need to also tell the system, right, what period, and you yourself need to ascertain the period you want to, reconcile for. If you are reconciling as at a specific date, you only want to look out for transactions in a date, just select your date, right? Maybe it's 1st of January, select 1st of January till 1st of January, right? So but then, if what you are looking out for, in as in the case of our exercise, we are looking out for reconciling for January transaction. So what we'll do is from dates is from the 1st of January till the last day of January 2022. Right? I'll just pick this up at the 1st of January 2022. And yeah, I now need to enter statement balance. This statement balance that we are talking about here is the statement balance I would have, in my Zenith Bank, my Zenith Bank statement. So as at the end day, of January, which is January 31st, 2022, that I'm reconciling for now. So what is my ending balance? And I would only get that from my bank statement anyways. So you need to look into your bank statement and get, your closing balance for January. And if you check this based on our exercise, it's told us here that we were given that our statement balance is 774,500. So we need to impute that in here. Right? 774,500. Right? And one thing you will notice this. Look in here. We have previously reconciled 750,000. Right? Reconciled now 0. Reconciled total, difference 24,500. Now, automatically the system has computed, our balance, our computer balance for us, which is what you are seeing as balance here. It doesn't allow you impute. Now, statement balance is 774,500. So we would easily know here, right? We now need to check. These are our transactions for the period, right? For January in Zenith Bank. And what do? We now need to look out for this transaction we've posted in the system, right? In line with what we have in our statement. Some systems allow you to do automatic bank reconciliation. That is, you can always import your bank statements and reconcile, and it's much more easier, right? You just need to do some what we call mapping rules. So when you set mapping rules, then it makes reconciliation easier, at least to a large extent, right? But some systems allows you to do that, in a manual form. And what do I mean by manual form? It simply means you need to look out for these transactions that you have listed here, right? And compare compare it with what you have on your bank statement that you must have printed or that must have been on Excel, right? Take for instance this electricity expense that is 20 like this electricity expense here, right, for 30,000. Let's say I'm able to see it on my bank statement. What do? I just click on the checkbox, reconcile. It simply means I've been able to see this, right? I'm okay with this, right? And I'll move ahead to say, okay, on the 12th of January, right? We have a supplier payment that we did to Greenwood. Check your bank statement. Is it there? If it's there, you check it. Okay, I've been able to do this. This is okay, right? On the 8th of January, there was a supplier payment of 100. So you start checking. So in here, you'll be able to see. And the more you check, right, the more you would see, the total you are able to reconcile in here, right? And you will see the difference, and you see wherever it is that any particular difference, might be coming from, right? So check this. This is fine. This is fine. And with reconciliation, you will be able to know. Let's say that this Progress Limited here, yes, Progress Limited paid us, right? They paid 120,000. But if that 120,000 we actually paid into another bank, say GTB, but you couldn't see this 120,000 in your bank statement for Zenith, then you should note that it simply means you've posted, this transaction into this period and into this bank wrongly. And that is one of those things that bank reconciliation helps you to identify. It helps you to identify if you've made any wrong posting with respect to your bank, right? And what do? You would reconcile it, right? You go back to edit or to reverse that document and now post it correctly, right? So, but in this instance, we can find it, we can find this, and it's okay, right? Now, look at what we have here, right? We've been able to reconcile the total of 775,000, but then there's a difference of 500 naira between what we have in our bank on the system, right, and what we have, you know, in our bank statements. You can see 775 in our system, and we have 774,500 in our bank statements, right? There are things that would have led to this, right? Let me just to be sure that we are still together. uh okay, so we are still together here, so just to be sure, so I'll treat that question now. So, but then we've been able to reconcile this and we've been able to see the difference. And this difference could come in so many forms, right? In fact, this difference could even be that, oh, maybe there are some payments that we've done that must have been reversed, by the bank that we are not aware of. So we thought probably as at yesterday we made a payment, and we thought it's, we've been debited. But then let's say the bank, total they refunded that money and we were not aware on time. So bank reconciliation could help us easily, get to, to that, and we'll be able to see what was causing our difference. And we need to be able to say, okay, we've been able to see this in our system, we've been able to reconcile this. Okay, this is what we have that is outstanding. And okay, is this amount? Okay, they returned it. And what do? We need to process that same refund in our system to ensure that our balance would be the same. Another thing could be this. It could be that there are series of bank charges that our bank must have charged us that we are not aware of. They could say account maintenance fee and the likes, right? Our bank statement would make to us, will make available rather to us this set of information, right? And in this instance, the best I could think of here, this 500 naira, is we could just treat it as bank charges, right? Let's say it's a bank charge that we are yet to recognize, right, for the month of January. What do? We save this reconciliation, right, and we'll go and post the bank charges of that 500 naira difference, right, and we'll come back to reconcile, and we should be fine at that level, right? So that 500 naira difference, let's now process it as a bank charge under banking. So I am assuming that we've been able to check, our records I've been able to say, oh, this is the 500 naira that is causing the difference. So we need to come back here, select Zenith Bank, and let's say it's as at the last day of January, sorry, 31/01, 2022, right? Uh, bank charges, for January. Okay. So account selection, bank charges. Okay, bank charges, reference, let's just let me say the reference is bank charges, no VAT. You need to always you need to be mindful. So spent, the money was being deducted, sorry, 500 naira, right? We do that, we save changes and we mark, as review. So if we go back to our reconciliation, right? Select Zenith Bank from 1st of January. Okay. So we want to finalize our reconciliation now, 2022 till 30th. So your reconciliation, could be as you so wish, your period. It could even be in a week, right? It could be from 1st to 7th of a particular month, as it might please you. So now remember 774,500. Okay. So look down here. It says that we've been able to reconcile the total amount of this, but then 500 is still a difference that we are yet to reconcile. And you see it from here. Look at every other thing is being reconciled because we ticked display reconcile transaction. If we have excluded this, say it will only give us that transaction that we are yet to reconcile for that period, right? But I wanted to display all others that we've reconciled before. So I said display reconcile transaction so that we can see the one that is odd. So we want to reconcile it, and our reconciliation difference is now 0 because now we've been able to reconcile all what we have for our bank, and what we have on our bank has now total, it has tallied with what we have in our bank statement. So I would save this, and I can choose to print this out, in to compare what we have in our bank statements, originally. So if there are any questions for me, let me quickly take them. So yes, so Adebisi Omota is saying, I understand the corrections for ongoing tweets, customer and vendors are best treated via reversals, via returns and credit notes. But how do we make corrections for the wrong classification and expense? Okay, fantastic. E.g., an electricity bill payment wrongly posted as maintenance cost. Okay, very, very fantastic. Right? Now, a wrongly posted, expense, you know, should you want to correct such, there are two ways, in fact, there are several ways of doing that. You know, one of the ways at which, you can do that is by you raising what we call journal entry. One thing you should notice this, a typical example of what the question here is saying is, let's assume, that an electricity bill payment, was wrongly posted as maintenance cost. Fantastic. So now we it's an electricity bill, but we posted it as a maintenance cost. Now the correction, note what was affected now is not just our bank is fine, right, with the amount. We've posted that we've recognized the expense with the amount, right? But then we can correct either via journal entries, right, by saying, okay, we want to, take out that money from, maintenance, that maintenance, expense ledger, and now properly take it to, the electricity expense ledger. We can use a journal entry, and a journal entry is very, very applicable, of course, in this case, because it's a ledger to ledger adjustment, right? Another way you could deal with it is because some organizations are very, very skeptical, with respect to they just raising journals. I understand as an accountant, you might say, oh, since I know the nature, let me just raise journal. It's still fine. At the end of the day, you still get the final result, right? But then another way you can go about it, and I'll show us how to raise journal entry also, just now. So another way you could go about it, right, in the system is to say, because the system allows you edit. The moment you were trying to reconcile and you found out that, oh, this is a wrong classification, if you have the right, you could easily go back to your banking, and edit the transaction. You go to review the transaction from a particular period, say for January, 2022, and properly classify. You can do that also. That is also permitted in Sage, business cloud accounting, right? But if it's a system that does not allow for such, for editing, right? You could either raise a journal, right? Or you could pass, you could come to the banking screen as well and do, in this case, okay, let's see. Let's say, okay, we are looking at reviewed journal for, let's say, cash in hand. Let's say we have a couple of expenses. Okay, we have expenses called electricity, or we have an expense called security of station here, right? 12,500. Now, if I want to correct this without using journal, what would I do? I would easily go to a new line here, right? Firstly, I need to reverse the earlier transaction. That is if I'm not raising a journal. Now, I can choose to reverse the earlier transaction by doing this. I would go to the first, I would come here, say that I will use the same date, 701, 2022, right? And I will come here, I will say reversal, of, reversal of, wrong posting or wrong classification. Just have it, just have the description well stated there. Then I will come back here. I will select that same wrong entry that I've selected, saying select security. I'm assuming I'm reversing security of station that we have as line 1 here, which is 12,500. So I will come saying reversal of this. I'll select the same that wrong line item that I've selected, that wrong ledger. My reference will be reversal, of course. Then now, this is in a spent column, right? To reverse that line, I need to impute that same figure in that same date, on that same date. I need to impute it in the received column. What that simply is saying is, it's came in, it's coming in and it's going out. It came in and went out. Do you understand? But then they must be the same date, right? Although when you are reconciling your bank, you will see that, oh, this money, and you would have seen it because they would be beneath each other, from your system. You would have seen that, okay, this 12,500, and okay, the next one you would have seen it, the description will be clear. Reversal of wrong entry, and you see 12,500. It simply means that transaction have been reversed, right? It's just that, and if it were to be in received, the amount were to be in received column at first, you would just impute it in spent column in the other way, in that other instance. And, the spent would cancel out the received. But then they have to be the same ledger and the same date. Then what you have done is you have reversed that entry, right? That wrongly posted entry in your bank. Then what do you now need to do? You now need to now post now correctly, using the right ledger, right? You now need to do another line. Now correctly post, using the right selection and, inputting the amount in the spent column. So what you have done is you've reversed, then you've now posted correctly. So anybody that is saying that set of activities would have understood that, oh, this is a wrong posting and it was reversed. Do you understand? That is one way of treating it. I stated that another way is to use journal. But journal, that's the fast one there. You just want to take it out from one ledger and the other. But then if you go back to check your bank, transaction within the system, you still be seeing, that wrongly entered ledger there. That's the difference. And the question now is, how do we do journal entries within the system? How do we do journal entries within the system? Yes, to answer your question, Formula, there is, yes, you can you can actually get a report on, VAT posted for the month. I'll be showing us that. I'll be showing us that now. So I don't want to save changes here on my banking. I only use it to explain. But then let's quickly look at how do we process journal entries within Sage Business Cloud accounting system, and how does journal entry works. So to process journal entry, you would always need to do that from the accountant area, right? You do that from accountant. So when you go to accountant area, you have that tab called process journal entries. So the VAT section is what we'll be looking at after this, right? But then you go to process journal entries, right? Select process journal entries, right? But there are some specific things we need to know about journal. Journals is not just to be posted anyhow when using a system, please. There are some specific things you need to be wary of. You need to note, right? I'll be telling us as we proceed, right? But then this is journal entry. But when treating journal entries, right, you should note that a journal comprises of accounts to be debited and accounts to be credited. And as you are aware, journals, will be used, number one, in cases where you want to reverse or correct some entries, right? And there are also some specific, transactions that will relate to journals. It could be end of the year audit adjustments. When you are being given audit adjustments, you could, you will pass it via journal. You can be given audit journal to pass, and the likes. So journals is majorly used for adjustments, correction of entries, and there are some classification of transactions that you might want to do that would run journals too. But one thing you should note is this: your total debit and total credit for any journal entry must always balance, right? That is one. And secondly, there are some set of ledgers that you should not, right? On any system, you should not process journal entry for two, right? Remember, at the start of treating opening balances, I stated something. I said there are some ledgers that we tag as control accounts. Your account receivable control, your account payable, which is also your trade payables ledger, and your inventory. Those are three primary control accounts, that you should never pass direct journals into, right? Let's say you want to adjust anything customer wise, customer pay. No, 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 don't go there. Don't do direct journal posting into those ledgers. Because when you do, right, it simply means when you generate your report at the end of a certain period, right, what you have as your ledger balance would not tally with your individual schedule. I explained what the schedule is at the first part of the training, right? And you can always go to, the video session to capture that. But because of time, right, you should note that you should not pass direct journals into your control account. Don't say you are too good with journals, and you now say because this transaction now is between our receivable and this, you now went. No, 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 no. It's very, very wrong, right? It's extremely wrong. And see, the honest thing is you are actually creating more problems that you can imagine, right? And now, how do we raise journal entries, right? Journals, just like every other system, also works with dates. So you need to ascertain the date that you are selecting. So let's say the date for this journal is 31st of January 2022, right? And in say business cloud accounting systems, we have a column called effects. So which is very, very important here. So the effect here is the first line of entry you are doing. Is it a debit entry or is it a credit entry? Those with accounting knowledge understands that part, right? But you can choose to treat either of it first. So if you say, oh, what you are doing is a debit entry, it simply means this ledger account I want to select here, right, is a this journal is a debit into that account. Now, a typical example of that is, the case of the electricity expense that we are talking about. So let's say we wrongly posted, an amount, for stationaries or a certain chunk of amount, for say security, and or it's meant for electricity, but then we posted it into security, and we want to correct it, by using journal now, right? What you do is fine. That means the money was firstly posted into securities expense, right? So it was debited there initially. So to correct that simply means we want to credit security expense and now debit the correct, expense, which is electricity expense in this case. So debit here would be our electricity, right? The reason for that, those that are accountants, they know, right? So now we want to tag our reference. My reference could be, correction, anything at all. So this will be correction of any expenses at all, or let me just say, journal, for because of time. Let me just say journal entry, but your description could be anything. So your journal should always be no VAT, of course. So what's the amount in question that we are talking about? Let's say it's a total of 1,000. I'm just saying, I'm coming up with figures in my head now. So let's say it's 1,000. Then we now have buy affecting account. There's a column for buy affecting account. What does buy affecting account mean? So it simply means now we are saying we want to debit this electricity expense. What other ledger account are we crediting? That is the buy affecting account that we are relating to here, right? So now, in this case, it is our security expense. Remember, it is our security of stations expense, right? 1,000 naira. We've selected that. And this line here, right? It's a journal entry on its own. And we can enter several journals as we want, right? So this first time we've been able to treat the account to be debited, which is electricity expense, under the account section. And why is it, how are we able to ascertain that it's to be debited? Simply because our effect here is selected to be debit, right? Then the buy affecting account, which will be credited, is security of station expense, which I have selected, right? And what I will do here is save and mark as reviewed, and that's all. That's how you process a journal entry. So any journal entries that you want to raise, you can always raise it there, except for journals that have to do with customers, suppliers, and inventory. If you have to do those, then you have to do them from their individual module by virtue of what we call customers adjustments, and suppliers adjustments. So those will be with respect to customer journals, suppliers journals, with respect to maybe you want to reduce or increase balances, which of course would have a buy affecting account also that we need to ascertain, right? So the same thing, items. If you want to make provision for, I want to pass journals for items, then you do that through item adjustments, right? So that is how this works. So I'll save this, right? I can choose to save this and choose to mark all as reviewed, right? So, and that's all. That's how you process journal entries, within the system. And if you want to see the list of journals that you've raised in the past, when you go back to your accountant area, process journal entry, just go back to review journals, and there you have it. You select your date, refresh, and you can always, have it, for your, use. So now we would move to the part. Now we want to move to, reports. The beauty of this software is to say that, yes, remember, we started well by configuring the systems ourselves. We configured the system ourselves. We created our master record. We categorized them, well enough, right? And we've started capturing transactions, suppliers related transactions, and when we are to raise some specific documents, right? Then customers also, customers transaction, we've looked at that holistically. We've looked at bank related transactions, bank reconciliations. What are those things that we needed to do when it comes to those aspects? And we looked at journal entries too, right? Journals. As beautiful as it is, you need to be very careful when posting journals. When you post journals to your customers, the suppliers, ledger accounts and inventory, then what you are actually doing is actually totally wrong, right? Because by the time, imagine you are owing some set of customers a total of 2 million. And when you have a breakdown of Aziz owing you 1 million, uh, customer ABC, let me say customer ABC, A is owing you 1 million, B is owing you 500, C is owing you 500, right? But then, a certain customer made a payment. Then you want to process that transaction. You now said, oh, because you are good with journal, you didn't go to process it via, say, customer receipt. You just said, oh, let me do my journal. Maybe it's between my receivable control, and of course my bank. You now went ahead, you raised a journal with respect to that. The problem you've created. The problem you've created is this. Remember, in your schedule, A customer A is owing 1 million. million, B 500, C 500, but then C paid. You now went ahead, let's say C paid a total of 200,000. You went ahead, you did a journal, you processed the journal. And if you check your trial balance, because you processed the journal, your trial balance or your receivable control will be showing you, 1.8 million, right, as your balance. But do you know what your individual receivable balance, receivable schedule will be showing you? Because you didn't pass that 200,000 naira, you didn't pass it through customer C. You just went ahead, do ledger to ledger entry, right? Your schedule will still be showing you that customer A is owing you 1 million, B is still owing you that same 500, and C is owing 500. Then you now have your schedule, totaling 2 million, and your ledger is 1.8. Then it becomes an issue when it comes to audit. Because at all times when you want to do your audit, your schedule, your individual customers' balances must tally with what you have on your TB, right? And same thing is applicable for payables, and same thing is applicable for, of course, inventory. So that is why even when you need to pass adjustments, right, you need to go to individual mode to do it, and it is applicable in all softwares, right? So you don't just pass journals to control account. Please avoid it, because avoid that headache of reconciling, because you might not even know. It might be at the end of the year. Imagine you are reconciling for December, and this error had happened since February, and you've had series of transactions. It can be very hectic. So based on standard practice, don't do that, right? So that will lead us to our report. We'll be looking at VAT remittances and the likes. We'll be looking at a couple of other reports, income statements, statement of, statement of financial position, trial balances. We'll be looking at a couple of those reports, inventory related reports, suppliers reports, customers reports. When we want to do audit, what are those standard reports that we need to generate, to ensure that our audit goes well, and to show that we are not novice in this stage. Okay, so now we want to move to reports. Okay, so we have the very set of report we can look at. We can generate VAT reports, basically, right? We can generate VAT reports, one step. Okay, so now if you want to know your VAT, the VAT that you are expected, to remit to your regulatory agency, and how to go about it with a business card accounting, then you can easily go from your accountant module, from your accountant area, go to VAT returns and reports, right? And you could go to report, and of course, go to VAT, right? So here, you want to click on next, enter your VAT number. Could be anything, but for registered businesses that are registered for VAT, you would input your VAT number here, right? Then last VAT period end. So let's just for the purpose of the training, let's make it at 1st December 2021. Submission due date, 2021. Reporting frequency in months is 1. Okay, so yes, period. We want to close this period. Click on finish. Okay, so this is our VAT, our VAT return screen, right? This is our VAT return screen. So now from here, right, we have VAT returns and reports, and we have several reports that we could always generate here, right? We could always generate VAT report or VAT summary report, VAT transactions report. If you want to see VAT summary reports, we click on VAT summary reports, right? And the system would ask, for which date are we generating this report for? You can say we want to generate it for VAT period, or want to generate it selecting a specific date. So dates could be applicable, and we can say, oh, we want to generate our monthly report and want to generate for the month of January 2022, right? Do we want to offset, our credits and our credit sales to our credit purchases. If you want to offset it straight away, you can just take offset and click report. But we don't want to offset it. So let's view the report. Let's see what our VAT report looks like. So this is it. Okay, this is our summary report anyways. So for summary, right, for January 2022, look at our output VAT is 27,000, right? Our input VAT is 40,650, right? So our net VAT is saying 13,650. Hold on one moment. So our VAT payable, right? Our VAT payable here is saying 13,650, right? For the period of January. Hold on 1 second. Okay, let's generate our VAT transactions report. That makes more sense. Okay, so now I want to generate for January 2022. Select that and we click on view reports, right? So here, the system will give us, as you can see, this is our VAT payable, within the period. Okay, so these are a set of transactions. Okay, so suppliers invoices, is coming as a debit. So which is, of course, uh, our VAT input for the period. So our VAT input for the period, 30,000, 5,000. Right, these are our VAT input. These are our VAT outputs. And at the end of the day, we have a total, balance of 13,000, 650. Right, 13,650. It simply means, that what we have from this interpretation here. Okay, we have a credit note here, we have a tax invoice here. So these three, 1, 2. Okay, so it simply means this 13,650, right, is actually the amount that we are, it's reimbursable, right, from FIRS, from our tax regulatory agency, right? It's a reimbursable from our tax regulatory agency here. So, and this report could actually be printed. And if you want to drill down to what made up all these invoices that we are seeing, you can click here to even see them, right? And aside from that, the system equally reports the figures into your ledger. You can look at your trial balance, for a particular period, or your ledger balance for VAT payable, and you will see the amount that is due for VAT, at that present period. But this VAT report here, you can always, work around it ourselves too. You can always look at it, right? And look at, couple of several reports that we have there. So you can see VAT refundable. So this is the amount that that is claimable from FIRS. But then FIRS will not give you this money anyways. So it simply means if you want to file for next month VAT, you can actually claim. You still have this amount to be claimed. So that is how that works, to that end. So aside from that, let's now look at a couple of other reports. We can, look in-depthly with respect to VAT on our own accord, right? I would implore us to look into that. These are some of those things that play out in typical business scenarios. So let's just look at a couple of other reports, and let's start with financial statement reports, right? Let's start with financial statement reports. So as a business or as an accountant, right? A recurring invoice without having to raise a new one. Okay, yes. Okay, I'll treat that. I'll treat that rather. The system has a recurring invoice functionality, right? And I will be taking that shortly. Okay, so okay, before I look at a couple of other reports, let me just show us a recurring invoice. I find the time is not of the essence, but then it's still my topmost joy, or our joy at Droidedge Consulting, is to ensure that we take as much as we can, away from this training, right? We take as much as we can away from this training. So yes, in typical business scenarios, we do have what we call recurring invoices too, right? What is a recurring invoice, and in what instance do we raise recurring invoice, right? So we have invoices, we've understood that part, right? But then we have recurring invoice. What's the difference? The difference is pretty simple, right? So if we have a set of customers that we do service, we have a standing order or a retainership with them, right? Then that, okay, every month, we always raise invoices. It doesn't change, right? They tell us, oh, maybe we render support services for them, right? So on a monthly basis, we do send them invoices. So to save yourself that headache, as an accountant, as one who is in charge of such function, you can actually make use of recurring invoices rather than raising invoices every month, every time. Imagine you have a couple of clients, 20 clients that are on retainership. Then you want to come to the system and start raising those invoices? No, it's very, very hectic. You can always make use of recurring invoices, right? So, and if you have a software and you are in a typical scenario like that, right? And you have a software and your software is not catering for that. So you need to ask questions, because a good system should have a recurring invoice provision, right? Such that once an invoice is due to be raised, the system raises it, at its own accord, right? So to do that, you go to customers, and it's also applicable for suppliers too. You can have, suppliers recurring invoice. It's equally possible. So for customers, you go to customers transactions, then you have recurring invoice. You create a recurring invoice. You select the customer in question, right? Select the customer in question. Oh, sorry. This is how the new customer. You select the customer that is applicable in question. Let's say Bakers Nigeria Limited, right? So the only thing you need that is different, the difference between recurring invoice and normal invoice is this recurring invoice setup, right? This recurring invoice setup here is saying what day do you want the system to start, this recurring invoice functionality for you. You select your date. Let's say we want it to be January 1st, right? So January 1st, 2022. So at what frequency do you want it to be? So I want it to be every month. It could be every week. It could be, depending on your business scenario. But I want it to be every month because it's a monthly invoice in my own case, right? In your own case, it could be different, right? So when it starts that, so at when do I want it to end? If it's January, February, March, if the invoice is supposed to run for 12 calendar months, right? It simply means it will end in December, right? It simply means the system will automatically raise itself, the invoice from January to December as at when due, right? So what is the due date for payment on that invoice, individual invoice? Is it at the end of that month, or due date for payment? We understand what that means. We can always set that here, right? And do we want the system to create that invoice automatically, or we want it to raise it as drafts? Raising it as draft simply means maybe there are some times that maybe the amount is not that stagnant. And maybe when it comes to a particular month, maybe due to the level of output that you've serviced them, you just need to modify, that quantity or that amount. So you can choose to save it as draft. But if you want it to be automatic, you can always choose, to make it automatic, right? And you want the system to always email it, and the system has that functionality. You can always choose to email and set your email signature. Then after you've done that, just select the set of items that you want to be on that invoice. It could be service and it could be physical, right? Select them, input their price, and click on save, or save and new, and that would start, work. So it simply means at the end of every month or at the beginning of every month, depending on how you've set it to be with respect to the start date, it simply means on the first of every month, the system would always raise. If I set it to be 15, simply means on the 15th of every month, the system would always raise. Do you understand? So that is how it is. So that's recurring invoice anyways. So let's just move back to our report because of time, right? So let's look at our financial statements. It's not enough for you to say you are using a software, you are using a system, and you cannot interpret reports, or you cannot generate meaningful reports on your system. It doesn't make any sense. It's not good enough, right? So now there are a couple of reports that you need to be aware of. There are a couple of reports that are very, very useful for you, right? That you'll be needing. And the report is what we'll be looking at. So let's start with financial statements, right? So for financial statement, you will be making use of the report module, right? For under report, we have financial statement. We'll select financial statement here, right? And the financial statement comprises of, three primary, with respect to business cloud accounting software. It has three primary set of reports. It has your statement of profit or loss and other comprehensive income, which you call, or which some layman know as profit and loss reports. Do you understand? It has that. Of course, it has statement of financial position, which is also called your balance sheet, right? And it has what we call your trial balance. But some of those things we'll be looking at earlier, right, with respect to report, is how to make use of our filters, right? We need to know how to generate good reports from the system. You need to know what you need to look out for in any system at all when you are generating reports, right? And that leads us to we looking at our financial statement report that we have. We still have a couple of other reports anyways, but when it comes to financial statement wise here, we have the system calls it profit and loss, because the system is trying to relate to the to a layman there, right? And it gives a brief description of what the profit and loss would is expected to give you, for some of us that didn't understand that what it does. But then we'll be taking profit and loss at first, right? So I will click profit and loss. So please confirm if you can still hear me clearly. And okay, I'll zoom my screen. Okay, I will do that. So please confirm if I'm good to go. And I hope we are together. I hope we are really having a nice time, during the training proper. So please confirm. I need a feedback from us to be sure that I can proceed and to be sure we all are on the same page. All right. All right. Thank you so much. Thank you so much, everybody, for that. Okay. So we'll just continue. Right. Okay. Yes, exactly, Abraham. Yes, I stated that earlier. I said, it's called statement of profit or loss, and other comprehensive income. Do you understand? But the reason why it's called profit and loss here is because the system is trying to relate, to a layman. The system is very, very easy to use, right? It's very, very easy to use. So that is why the system is tagging it as profit and loss. But we know that, in real sense, right, it's called profit or loss, just like you said. uh you can't make profit and equally make loss. So you could either make profit. If you are not making profit, you are making loss. So that's why it's profit or loss. So profit or loss, but then the system is tagging it as profit and loss. Just is because it's a term that they use to easily relate to a layman, because most laymen know it, as profit and loss. So let's just work with it. So now let me zoom my screen. So now we are on profit or loss reports, right? So one of the very first thing that you need to make good use of is your report filter. Report filter, what do we mean? When you are generating a report, if you are generating a report for February 2022, it is different from you generating a report as at February 2022. They are different. You're only generating a report for February. It simply means from 1st of February till 28th or 29th of February, right? It's different from you saying you are generating a report as at 28th of February. So that's why report filter is very, very important for us to make good use of, right? If you are saying you are generating as at, it simply means you are considering balances, previous balances, in that financial year, right? And that is what we'll be looking at here, right? So date range, it is very, very, very important. You could be asked to say, oh, let's generate our profit report for this week. The way you generate that will be different from generating your profit or loss for the whole year, right? So now date range here is very, very important. Now, what do we want to do? We want to do two things. We want to generate, our profit or loss for the entire year, right? And we want to generate our profit or loss report, for a particular month, right? So yeah, if you want to and we can choose to generate for a quarter, for a quarter, say first quarter, second quarter. We can choose to equally generate it for year to date, to say for the first of the financial year till this present moment, right? We can generate for last year, current year, and most importantly, if I select monthly now, we have current month, I can say I want to generate for January 2022. Simply means my report will be basically for January, right? for January alone, right? So if I select February, simply for February alone. But if I generate, yearly, it simply means my system would always, if I select 2022 as my year, for the whole year, that's what this report would give me, right? And again, if I generate to say, okay, I want to generate for custom dates. In fact, I love using custom dates. Custom date for profit or loss report is saying you want to tell the system the earliest date that the system should consider. For instance, your management could ask you, let's see our profitability from the 1st of January till January 15th. So when you want to generate such a report, you select custom dates because you want to be able to select your own date yourself, the date it should start from and the date it should end, right? So here you would select, say we want to generate from January up until November now. So I will just select from January to November because I have that flexibility, because I've selected custom date, right? So that is what I want to do now. So I've selected that. So then I have another option here saying cost of sales based on, cost of sales based on either purchases or sales. But note this, your cost of sales should always be calculated based on sales. Why is this? Because when you are buying an item, you know, at that point you are not, they are not in your cost of sales, you are not expensing them. So you would only recognize cost of sales on items that were sold. So if you buy 50 items in January and you sold 20 units of it in January, for the purpose of that January, right? Your cost of sales, you'll be receiving your revenue or your sales for that 20, right? But your cost of sales, you will not charge the total amount that you paid for that 50, as your cost for January. No. You would only charge your cost of sales for those items that you've sold, right? And that's why we have what we call cost of goods sold. That's why you have calculation for cost of goods sold, when you are preparing your manual accounts, right? So always note that cost of sales should always be based on sales. Select that. Please always have that at the back of your mind, right? Group by, of course, that's fine. And display, always display decimal place. So that if you deal in cobbles, the system would reflect such, right? If you fail to display decimal places, then automatically the system will just round them up, right? So we are displaying decimal places and want to view reports. Okay. So the system will display our report for us. One moment. Okay. So now we have our profit or loss report, and this is so sorry, it looks so tiny, right? Okay. So we have here, I will be shifting the cursor. So we have here for our revenue, which is also called sales in this case, right? Remember when we were creating our individual items, because of our reporting, we stated yesterday that because, and that is where we come to play, being consultants, we can help you configure your system so that your revenue item, you can have it splitted rather than just having the whole of sales reporting as one amount. So you can have it splitted to say, oh, this is the sale we made from this set of activities. This is the sale, we've made from this segment or this division of the business. Do you understand? So if you're dealing with phones and laptops, you can know the amount I'm making from phones, the amount you've made from laptops in this period. You can even go further to say how much have I made from HP, as a product and the likes. It goes on and on, right? So now for sales, right? Okay. So for sales, let me zoom out. Sorry about the tiny screen. So I just want to show us an overview. So for sales, seafood, we made 180,000 from seafood. From storage services, we made 110,000, right? And this has to do with the proper classification we've done for our items. So management can easily make decision here to say, okay, we've made more from seafood, you know, uh as opposed to storage services. And the total, revenue for the period is 290,000. Yeah. Then we have our respective cost of sales, which from here we can always say that if we remove our cost of sales of seafood from the revenue for seafood, we would have, our gross profit contribution of seafood, into the business. Do you understand? So now we have it like that. We have our gross profit to this amount. Then we have other income. We don't have any other income. It's currently zero. Then we have our respective expenses, right, within the period. And at the end of the day, right, it's unfortunate our expenses, were more than our revenue. And as such, what we made is a loss, right? We made a loss of 38,192, right? So that's just how. So you could make profit and you could make loss. And mind you, as a business person, as an accountant that is not making use of the software, you might not easily know. Imagine the number of headaches you would have gone through in doing this on Excel, and you could even come tomorrow, you open your Excel, it's not opening, it's corrupt. You have to redo all your books manually. So, but with a system, you have your reports. It's there for you, and you could easily export this to Excel, send it via email, export it as PDF, and the likes. By clicking this button here. So you can export it to PDF like this, export it to Excel, and if you go down, you can always click export to Excel, export to PDF, print it, and the likes, right? But then this is a report that was generated from 1st of January to 30th of November 2022. So if you want to generate for January alone, you just click on show report options. You just select from 1st of January to 31st of January, just like we did. Or if you just want to generate, if it's a daily report that you are generating for your firm, you can just say from 1st of January to 1st of January. You understand? So the system will still give you the report for that day, your sales for that day, your profitability for that day, right? And that is how it works. There's not no transaction for January 1st, right? Let's see January 2nd, right? And that is how you make use of report filter. So that's how income statement works, right? And okay, you can see this is the report for January, for 2nd of January alone. So we can see the total. Okay, there was no revenue for that period, but we incurred expenses. Do you understand? And if you can always drill down to how that amount is being made. So, okay, this is all the expense. Where is it coming from? If you click it, you will see, what made it up. If you click the revenue also for seafood, you will see what made it up, right, at the end of the day, right? So that's what profit, statement of profit or loss, and other comprehensive income. So, let's quickly move to balance sheet, right? Is there any question? Yes, is RFRS compliant, of course. Someone is asking what's the exclude account, doing there. So exclude account doing there is simply saying that the system gives you the flexibility to say, okay, you are generating your report, but then you don't want a particular account, to be reported alongside. So you can just select that as an exclude account, you know, to exclude that general ledger account from reporting. But then why would you want to do that? So it's always good you leave it out and you show everything, unless you have an account that is inactive, right? And that's why. So yes, the system is definitely IFRS compliant. Yes. So for balance sheets now, balance sheets, or statement of financial position, like is being called now. Balance sheet, has to do with is it has to be generated as at a certain date. Remember, balance sheet account would always have balances and they will always roll over. So for the case of balance sheet, you would always generate it as SAT. So that is why you see the filter. Let me zoom this screen. That is why you will see this filter here saying run as at. And as at what date? Your balance sheet that you are generating for is as at what date? So if you want to generate it as at end of January, so you just go back to January and say as at January 31st, and you click on view reports, right? You click on view report, and the system will give you, your balances. So you will see, okay, your asset account, you see your total non-current assets, just like IFRS, wants it reported. You see those assets that are current in nature, both those ones that are cash and cash equivalents, and those ones that are inventory. So prepaid rent, you can see VAT payable. You see VAT payable is reporting as current asset. Why? Simply because it's FIRS that is liable to you. So I didn't mean it's those set of amounts, the VAT amount, is to be I didn't mean it's a liability to you. it will be reporting on the current liabilities. But because what you have there, it's a VAT refund and not VAT remittance. Do you understand? For some of us that are accountants, they already understand what I'm saying, right? So, but what I'm trying to just bring to our attention is we have current assets, right, in here, right, and we equally have equities and liabilities. You can see our total assets here, and at the end of the day, they would all balance. Our total asset is 3251, both those that are non-current and those that are current, and those ones that are intangible in nature and the likes, right? And we have our owner's equity, which is our share capital, non-current liabilities, and those ones that are current liabilities. And if you want to know further, to say, oh, these trade payables of 107,400, how did it come about? So we can also further click on it, and the system will give us how the trade payables came about. Look at, so as at a certain period, as at that January 1st, look at the set of transactions that made up what we have in our trade payable ledger. So you can have it like that, and it goes on and on, right? So that's one of the beauty of having an accounting system in place for your firm. It saves you so many headache, when it comes to report generation. So because of time, our time is fast spent. Okay, so let's just look at trial balance. Of course, our trial balance, mostly is always hazard also, but then the system also have a flexibility to say, because there are some firms that when generating trial balance, they could say, okay, let's even see our trial balance for January alone without, accumulating or without previous balances. If you want to do that, then you need to set to custom dates, right? But if you want to generate hazard, your TB as at a particular period, if you want to generate your TB as at January, you just select year to date, right? Or better still, you select what's it called? You select monthly, and you select your particular dates that you want the reporting to be from. Or you can equally select, all, to see all your closing balances for a particular period, and you click on view report, and your trial balance, will definitely be balanced. So remember, your trial balance and your trial balance will also be needed when you want to do, of course, audits. So remember, when you want to do your audit, the set of reports that you'll be needing your trial balance, of course, one standard. Then you'll be needing your respective schedules, like I explained to us at the point of opening balances. You'll be generating your customers receivable balance, suppliers receivable balance, and the like. So take for instance, I have here my trade receivable. So I can click on drop down for me to see how they came, about. And another report, aside from trial balance that you generate, you can also generate, or aside from financial statement, you can also generate customer related reports and suppliers related reports, right? So here you can generate what we call, customers balances report. You can generate your customer statement, individual customer statement for customers. So you could be asked to say, oh, send us customer statement. And another beautiful thing is this: if you want to open, I can choose to open, this customer statement report in another tab. So I can just right click on it and open it in a new tab, or customers transactions report. There a couple of reports like that. So let me generate customers balances, for example. So your customers balances is also called age analysis, your customers age analysis. Yeah. So as at what date? Let's say as at today, how much is our customer owing us? All right. So we don't want to filter. Okay, we want to see both those that are active. Then we have the option of selecting, do we want to generate a summary report or a detailed report? Summary report is saying it will only give us our balances, the customer's balance, but detailed report will give us the balances and the set of invoices that are still outstanding, right? But we want to generate summary. We'll click on view reports, as at today's date, right? So this is what our customers are owing us. Bakers Nigeria Limited, you can see this report is this balance of 200,000 is over 120 days. So it simply means we need to do all we have in our capacity, to get that money out. And that is why organizations, have what we call credit control, policies, to ensure that we get, receivables on time and the likes. So this is a typical receivable schedule, and you see that 646,750. And if I check my trial balance, I should be having the same thing, as my receivable report. So same thing is applicable for suppliers. There are a couple of reports. You can see there are many of them. Because of time, we won't be permitted to run all through everything. So you have suppliers statement or suppliers transactions. Should you want to reconcile your suppliers, your transactions between you and your supplier is saying, can you check our statement from your end? Can always generate it for a particular date range by using custom date to say, oh, from the first of this period to this period, right? And you can equally say, oh, you are generating it, for a specific month and all. So if you do that and you view reports, so you easily see, for all your suppliers, and you can easily limit it to a particular supplier, right? So that is how it works. There are a couple of reports like that. Inventory, yes. Another basic report that you'll be needing, okay? I'm looking at time. Another basic report that you'll be needing is with respect to your inventory. You'll be needing two major reports. You'll be needing an item valuation report, right? Item valuation report would always be generated at every point in time. Be it the end of a month, you can be asked that what is the total value of our inventory that we have now. A report that will help you with that is item valuation report. And an item valuation report has quantity and cost in it, right? It has quantity and cost in it, and it will give you the value. So you can always generate your item valuation report as at, a date. Let's say we are doing audit or want to do store count, we can always generate a report as at the last day, of a financial year, of a financial period, right? So we would generate that based on average cost and just view, report. And we can choose to exclude items with zero quantity on hand too, right? You see that we have here on hand, we have cost, and the system will give you the total value. So the total value of items we have on hand now is 603,000, 911.67, right? Item valuation, inventory valuation is also a supporting, reports that you'll be needing, that will go alongside your trial balance when you are doing audit or when you want to carry out audits, statutory audits within your firm. So another report that is basically important for item is what we call item movement. There are instances where, as an inventory person, as a finance person, I need to reconcile, what you have in inventory. How many quantities did we receive, and how many did we sell, or did we, issue out within this period? Item movement report would help you. So aside from cash and bank that you need to reconcile, you would always be needing to reconcile inventory too, because you need to know if what you have as a valuation is not correct. What they've counted is 30 and what you're having on your system is 35. You need to reconcile, you need to generate a report called inventory movement report, within your system, and so as to gain more insight and know what transactions did we omit, what transaction did we wrongly post, where we are supposed to have issue 10, did we issue 15 wrongly in the system. Inventory movement would make that available for you, and we can equally generate, let's say for a particular month, we can generate it for a specific period, and it could be detailed and it could be summary. Summary will just give you quantity in, quantity out, and you are done, right? And would give you detail would give you the individual quantity you received and the date, and the individual quantity it is that was sold and the date. So, and I forgot to show us something here. So another thing here, remember, this is where category comes to play. If we want to generate our item valuation, our item movement, we could be asked to say, okay, what category do we want to generate for? We could easily say, let's only generate item movement report for seafood, right? We can easily say, let's generate item report, for seafood. So that is why this category is very, very important. That is why it's always good to categorize, like I emphasized at the point of creating. So you will see for prawns, for this date, we received 10, we sold 5. In this day, we sold 2, 5 was returned as a result of credit note, then we have 8, and you can always drill down to individual source documents should you want to, right? So that's also another report that you can always generate, and which should be available in almost all the systems. So you could be asked, if you want to reconcile your inventory, what sort of report do you need to generate from an accounting system? It's very simple. It's simply inventory movement report. right? Inventory movement report would help you to reconcile. So that is how it is, right? So there are a couple of several other reports, right, that you have within the system. But because of time, right, I would just want to stop here and take our questions, right, and see. I want to believe that we really enjoyed the class, and okay, so there are a couple of questions here. Okay, so now I have a question here saying, is balance sheet an account or a statement? You know, balance sheet is a statement actually, right? It's a statement and not an account. You know, is a statement. It's being called statement of financial position, right? And so balance sheet is a statement. Okay, so what of budget management and payroll? That's by Victor. Yes, uh, yes. For budget, the system allows you to do budget, but then budget, you know, it's we normally look at budget and a couple of you know activities, you know, with respect to the system in our advanced class. So we normally have an advanced class also where, you know, budget and even time wouldn't even permit, you know, for us to look at that critically, you know. But then we look at budgets, you know, we can look at budgets in our advanced class because we equally run, you know, advanced classes, you know, where we look at importation of couple of you know, transactions and the like. So now, but payroll, no, no, no. This system won't do payroll for you. It's basically a typical, you know, finance and inventory application. So finance, inventory, and a little bit of procurement, you know, application. So it's not a payroll system, but it has a payroll system that is well integrated. It has a Sage Business Cloud payroll. So that is another independent system on its own. But at the end of the day, they are integrated, right? Whatsoever it is you are doing on payroll will translate to your financials, right? They are integrated at the end of the day. But this is totally the finance part, right? So what are the types of VAT, if any? Yes, the type of VAT, yes, we have a couple of types of VAT. You have, of course, VAT input, VAT output, just like I said. Then you have exempt, you know, exempt is a VAT type. Then you have zero rated. You know, there's difference between when, you know, an item is exempted from VAT and when an item is zero rated. You know, an item might not be exempted, but then, you know, is zero rated. A typical example of that is this. Let's say we sell, you know, stores, we sell items, and items we are selling, they are vatable, right? But then if we are delivering such an item to an NGO, for instance, you know, to an NGO, remember the item is vatable, but as an NGO, you know, we are not allowed to charge them VAT. So such, you know, a document will classify for is zero rated, you know, because it you won't be using exempted. Those items are not exempted. Do you understand? But it's because we are not, you know, eligible to charge them VAT because of their nature. You know, there are a couple of stuff like that you need to just read up on VAT. So, but the VAT type, VAT input, VAT output, you know, I already explained what they mean. And we have zero rated VAT. You know, in some cases we have exempted if you are dealing with items that are exempted from VAT. So those are the typical VAT type. So yes, can the Sage business help to file returns for the year end? Yes, exactly. Yes, mainly by generating your income statement report, right? You can easily know from your profit, right? You can easily know how much it is, you know, that you'll be filing, you know, for company income tax. You know, you easily know it has its own computation. But what this will help you do is to help you ascertain your profit or loss for the period. You know, then of course, you know, because legislation differs across countries, you know, it differs across countries, you know. So what you now need to do is that element of you know, profit, you know, the amount that is going for company income tax, you know, the amount that is going for education tax, you know, and the likes, you know, and that's how it works basically. Okay, so yes, so there's a question from Taiwo saying, as an auditor, which areas should I check for possible observation? Yes, you know, there are a couple of things you need to always look at as an auditor. But then the system has a tool, an audit trail tool, right? The system has an audit tool, that if you go to accountant area, for instance, and you go to reports, you have what we call audit reports. So audit reports, couple of audit reports that we have audit trail and system audit trail. You equally have opening balances and VAT adjustments. So if anybody has done anything with respect to adjustment of opening balances, you can always generate report on that. And you have audit trail as well, to generate within the system. And the system equally has, what we call system audit trail. System audit trail is you knowing who did what and when was it done. Now, the system logs all activities that users carry out within the system. The username, and the time that activity was done. If someone have a right to edit a document and they went ahead to edit, you can always fish that out, within the audit trail. So we can say, you want the system to show you all what had happened, within which period. You can say you want to see all what had happened within a certain month. So you can say you want to know what had happened within the current month, right? Within 1st of November to 30th of November, and you want it to display the user. You can just click on view reports, right? And the system will give you to say you can see personal information was updated, financial year records were updated. From what to what? Financial year change was changed from this period to this period. Changed by who? Changed by this user. You can see, the user's email address will be given, and the time at which it was done will be given, right? This is with respect to systems audit trail, right? But then if you want to see, those transactions that are there, that they have done, because you always need to do that, you would always do that using your normal audit trail report. I opened it here. So using audit trail reports, event type. So what do you want to see? Do you want to see when a record was created, when it was updated, or when it was deleted, if that person have a right? So for this month, let's see, display the user view report. And you can actually see for a specific day. If someone should edit a transaction that's for last month, you can easily know as an auditor. The system has an audit trail too, right? And okay, so you can see that this user, right, created, a document, for this amount, right? You would always see, and the system is such that is also quite, robust. And that's just one of a couple of. Does it does the system charge depreciation automatically? Okay, so the system has an asset module, but then the asset module is not a full-fledged asset. So there are ways we go about the depreciation, but the system allows you to create such assets under the company's tab, like you have now, right? You can always create asset, add asset, and generate asset reports. But the system would not compute, the full depreciation for you. So what you can always do with respect to that is you can create, what we call recurring journal. You can create a recurring journal for, your depreciation. There are ways we do that. So there are ways we do that. You can always create a recurring journal for your depreciation, for your accumulated depreciation account and your depreciation expense for the number of period you want it to go for. Do you understand? So it works like that. So okay. So I think those are the questions we have for now. Okay. So okay, it's actually, it's been a wonderful time with us here. Okay, so now what's we've actually officially we've come to the end of the training, right? We've come to the end of the training. If you still have questions, you can still drop them. I'll answer them, right? So but then just a quick reminder, that our firm, is of course Droidedge Consulting, and we are based in Lagos, but then we have several clientele. We've been to several cities in Nigeria, for implementation, training, and support, as the case may be. So we deal with business management solutions. So we are experts, right, in configuration of systems for, talk about a full-fledged, finance system full-fledged HR and payroll system, right? A full-fledged ERP system, inventory system. So we do all this, CRM systems and all, right? Both cloud solutions and on-premise solution. So, and if you currently have any accounting system that you are currently using, and but then you're having one or two challenge on it, you can, feel free to reach out to us. Feel free to reach out to us. We'll be willing, to assist you on it, right? So, yes, Droidedge Consulting, as you can see, this is a couple of activities that we carry out, right? We are experts in this, and we've been around uh, for close to 10 years now, right? That we've been doing this, right? So we are, and you can tell even from the level of training that we just concluded that we are actually, excellent when it comes to service delivery, from our hand, right? So couple of products that we deal with, but not limited to this. And you have it, shown on our screen now. And of course, should you want to reach us, if you have anything at all, any info, that you would want to relate to us, right? You can always, send to info@droidedge.com, or visit our website www.droidedge.com. And of course, you see our telephone, our official telephone numbers. You can reach out to the team, and we'll be willing to work with you. So, and we would also be expecting our honest observation, right? Our honest observation, or rather, our honest rating, rather. So, we'll be sending with us a feedback form where we want to hear from us. Please, we are looking forward to a top-notch rating. Even though at the early part of yesterday's training, I think particularly to MTN users, I think their network was not that okay, and it's coming from MTN. It's just unfortunate, right? Please, just to encourage us to do more, we'll be sharing with us our feedbacks. Please, our Google review, we'll be looking forward to them, and just to encourage the team to do more and to do better. So we equally have a couple of other trainings that we run. Microsoft Excel training from beginners to intermediate to experts, right? And we do several trainings on QuickBooks as well, all right? QuickBooks Online, QuickBooks Desktop, and as the case may be. So feel free to reach out to us. It's been a wonderful time. Thank you all so much for making it to the training session, even though we know we have a couple of things, in our purview. Okay, so now another thing is this. I promised us something yesterday. I said the software itself, right, gives us access for 30 days, for trial version, right? However, let's say with 30 days has elapsed and we still want to continue the use of the software, and we still want to just practice any day, anytime, like we would always want to, right? You can always do that, from this login screen, right? There's a provision for what we call demo company, right? So rather than logging in, for the purpose of this training, log in, practice, and share, practice with respect to those class exercise. And we please share, your questions, your clarification that you need, anything you need clarification on, share it with us. Please feel free, please. So, but then if you want to access the software just after 30 days, just for the purpose of practicing and all that, you can always make use of this demo company here. You will see the demo company, button here. Explore the demo company. When you click on the demo company is readily available for use. So you can always create customers, create suppliers, create items, do all your, source document, do all your meaningful reports, generate, couple of things that you just want to see, you just want to practice. Any months down the line you want to practice, you can always make use of the demo company. It's just there. It's free, right? It's free. But for the purpose of practicing for this training that we've just done, please endeavor to log in properly. And of course, share with us your report. We are looking forward to seeing how your income statement report looks like, as for January specifically, for January. right? What your income statement looks like, statement of financial position, your customers' balances, suppliers' balances, and the likes, right? Please, we look forward to seeing that. And we'll be sending across our certificates, any moment from now. We'll be sharing with us our respective certificates and also be expecting the video. So we'll be sending you an email that houses the day one video, the day two video. Do you understand? And that also houses our certificate. So it's been a wonderful time, and thank you for for being very patient with us. I still remain your facilitator as is at the moment, and please feel free to reach out to us. We'll be willing to hear from you. And please, for some of us, we understand that some of us we are not able to join. From say some of us are on the group chat and they were not able to join. I understand some of them, because of a couple of challenges that they had in the earlier part of yesterday. So please, we need also your encouragement on the group chat so that people can be well encouraged even to go through the videos. And we just believe that when you go through the videos once again, you have every cause to appreciate that you attended the training session. And I'm sure there must have been one or two things that you've added as an addition, right? Yes, we'll be sending the link to the demo session. Remember, it's still accounting. When you go to login page, accounting.sage1.co.za, before you log in, the demo session is just beneath, right? So the demo company is just beneath. So the demo company is just created by Sage for people that should you get to the expiration of that 30 days and you still want to practice, you can always use that to practice, right? So thank you so much. It's been a wonderful time. Thank you so much, Timilene, my wonderful colleague. So we look forward to your honest review, your encouragement, and we just hope that you would recommend, this wonderful training to some of our colleagues going forward. So thank you so much. It's been a wonderful time in here. Thank you so much. I wish us the very best. So, but please, it makes more sense. Please, the group chat is for once we practice, and we have any question we might need, might be useful for anybody. And the group chat is not just only to maybe questions that is just relating to just what you've learned. It could just be what you think with respect to a couple of other subjects. Please share it and let people learn, right? And we would also be there to answer your concerns. So thank you so much. Thank you so much. Thank you so much. So do have a wonderful, we still have a couple of hours to go. So do have a wonderful day ahead and do have a wonderful week ahead as it's a first day of a new week too. Okay, thank you. So I will be ending the session now. So we'll just continue the whole conversation via private chat and via the group chat if you do have any concern. But please we sincerely need honest feedbacks even on the group chat so that the team could be more encouraged. Remember it's a discounted training that we think we wanted to reach out to more people and let people enjoy the fact that even with little there's so much value that you can enjoy. So thank you, right? And it's a bye bye for me. Thank you once again. Yeah, God bless you too. God bless you too, Duke.